recap what we did last week. So basically, we were giving a very brief introduction to what is risk management and what things you look at when you design a risk management framework and how do you do it. And very importantly, we discussed two main concepts: what is risk and what is uncertainty. So where the risk we can, risk is also about a deviation from expected result. Uncertainty also refers to the deviation from expected result, but the risk is more certain, where there are some possibilities with probable, probabilities. So we know the possible outcome distribution looks like. But in the case of uncertainty, which is more dangerous from a risk manager's perspective, we really can't estimate the possibilities and the probability of that particular possibility taking place, where we have to be extra careful. So then we looked at what is the enterprise risk management framework, the components of it, where one of the important things is, as risk managers, we can't mitigate or manage each and every risk an institution face, like your banks. So there are a number of risks faced by an institution on day-to-day business environment. So what we do is, once you assess the risk, we prioritize them depending on probabilities and the impact. So basically, we build a risk matrix to identify the most important risks which we need to address, because the probability is high as well as impact is high. So there again, we looked at different treatments. As a risk manager, we can avoid the risk, completely avoid the risk. We can eliminate the risk completely. We can mitigate the risk, and we can transfer the risk. So there are different types of risk mitigation techniques depending on the risk, where the particular risk lies on the risk grid or the matrix. Then we looked at how how the different attitudes of people or businesses vary towards risk, and how they look at risk and what measures they take. Each and every organization has different attitudes, and they look at risk differently, so that there is mitigation, or how they look at risk is different of the same business products or business line or whatever economic events taking place. So where I gave a couple of examples of two companies in the retail industry. They want to expand their business over the next 5 years, where the strategy of one company is quite different, which is more riskier than another company, the other company. But ultimate objective of both are same. So while both companies have the same ultimate objective, the strategies they wish to adopt is quite different. So one appears to be rather risky strategy, other appears to be a lesser risky strategy. But how they perceive the risk, that again depends on your attitudes toward the risk. So there we looked at from a business perspective or individual perspective, different attitudes: risk-averse people, risk-neutral people, risk lovers, and so on. So the same risk event, how they perceive and what they will do, depending on their ultimate goal towards a particular event. So I think we discussed about 4 projects, how the risk averse decision maker like your bankers, how they look at your bank, look at the risk averse institution. But there may be another bank which is risk neutral or maybe risk lover. So the way they look at different project is different. Okay. So are there any questions before we move on to the today's session? Are there any questions? So if you need to clarify anything from last week, now this is the time, because since this online session, I don't see you, I don't meet you. So probably throughout the course, this will be online, I suppose. So it's rather difficult for me, but so for you, you have opportunity to ask questions rather than waiting till last minute. Anything you need to clarify from what we discussed so far? Okay. So let's move on to the today's part, where we basically look at corporate governance and risk management. So if you look at risk management, in today's context, one of the most important things we relate to risk management is corporate governance. So if you look at the issues relating to risk management and corporate governance are mostly connected. Okay. So if you look at the failures that has taken place due to certain risk events or governance risk management issues in the recent past, always you can spot something on the side of failures of corporate governance. Okay. So that's why in the last 10 to 15 years, around the world, prominence has given to the corporate governance practices. So if you look at in most countries, the best corporate governance practices, codes of ethics and so on, has been developed during the last 10 to 15 years. Okay. So if you look at Sri Lankan banking system or the non-banking system, in fact, for the banking system, governance rules came into effect, I think, mid-2000 period, like 2006-07, where the regulators felt there are many issues relating to risk management linked to governance. Then they thought of bringing new laws or new governance practices to the governance framework of banking institutions and non-bank financial institutions. But if you look at broadly, the governance codes are applicable to other corporates as well by other institutions like SEC, Chartered Institute. There are corporate governance codes of related codes of best practices. So this is not just for what you call banks, financial institution, but in general for any corporate. When you talk about risk management, the governance is very important. Okay. So as I highlighted in my note, the necessity for change began with number of significant and well-known corporate failures. So basically, you know, it's like your two hands. One is, if you take your left hand as your risk management, then your right hand is the corporate governance. So you can't separate those two when you talk about institutions' failure. So questions, obvious questions that are asked when a company collapses unexpectedly. So generally, there are many parties ask questions when something bad happens, okay, unexpectedly. Now, you know, these days people ask how this COVID started spreading. A lot of questions. Okay, how it happened? Okay, why did it happen? Why did it happen? Okay, so there are different thoughts. Okay, why did it happen? You know, so if you look at COVID, started. It appears from the discussion so far, started in China, okay, due to, I mean, arose from animal certain types of animal, and then people who eat those used to get this virus. Then it spread to the Chinese people. Then the people start moving around the world. Then it spread to other countries and so on. So it's a natural question when an institution also fails suddenly. Why did it happen? Or how did it happen? I would look at prominent bank failures like Barings Bank. I think all of you know the Barings Bank. Okay, one of the oldest, I think not one, but that was the oldest merchant bank in UK at the time of its failure in 1996. So why did it happen? That's a natural question. What should have been done to prevent it? Okay, so have we taken adequate step to prevent it? So the question is, okay, this happened. So why it happened? Then prior to that, what we should have been done? Those are the questions. Because now we are reactive to the situation. So this is the problem among many of risk managers. We are reactors. Okay. When you talk about institutions' failure, especially the banks and financial institutions, you can't react because the cost of reaction is significantly high. So as risk managers of those institutions, we have to be very proactive. So we have to identify the possible things in advance, and also impossible things happen, then whether we are ready in terms of different parameters such as capital, liquidity in our hand to prevent such event. So what should have been done to prevent it? What should be done to reduce the risk of it happening? Okay, now let's say this has happened now. Okay, what things now we are thinking based on an event that took place. So now we are reacting and we are taking measures to reduce the risk of it happening again. So this is the way we are thinking. These are the typical questions somebody would ask, in something. How this accident happened? What should have been should have been done to prevent it, and what measures, even in a normal incident day to day, we talk about these things. So it's similar to a business. But here, when you talk about a bank or financial institution, we can't take them very simply because the risk is very high compared to any other business organization in any country. So if you look at analysis of many such failures has concluded that there are a number of common reasons behind those failures. So if you look at the historical failures of especially financial institutions and also any other institution, but certain things are very common, whether it's a financial institution or any other business entity, these are common. So the investigators have identified some common reasons. Okay, so what are those common reasons? But this is very important for you all as risk managers or people working in financial institutions, banks and financial institutions. When you see these things, that is an indication of possible risk of failure for your institution as well. So what you all have to do is if you see these things in your institution, immediately you have to take appropriate measures. So that's the importance of the past experience. But these are not the only reasons, but there may be many more reasons. And also there may be some other reason which we have not identified, but would lead to a failure. One of the important, if you look at failures that has taken place, one of the important, I think it's a general one also in institution, incompetent and dishonest senior management. So one is, if the senior management, key MPs of an institution is incompetent, they don't know what they are doing, and also dishonest, you will end up with a failure sooner or later. Dominant chief executive officers. I think this has been experienced in certain institutions in Sri Lanka as well, where the institution is run by dominant CEOs. Ended up with failure. So what do you mean by dominant here? So dominant means, I mean, any CEO has to be, strong leader, but he cannot be dominant. Dominant in the sense, he does what he wants to do. He tells what he wants to get done. Okay. Whether right or wrong, remember? Right or wrong. So that's the important point. So certain CEOs, very dominant, so you have to do whatever they say, whether right or wrong. Okay. You don't have any say. You just have to follow the instructions, orders. So that at the end, there are a lot of press and end up with failures. So you have seen, I think if you look at in Sri Lanka also, there have been certain, even banking institutions in the past, not recently past, have failed, especially with dominant CEOs. So you will see, even in an institution, when you see there are CEOs acting dominantly and take decisions without listening to the views of others, and whether they're right or wrong, then it's a signal of possible failure. Absence or lack of internal control. So if you look at risk management, there are 3 lines of defense. So the first lines of defense is the root level managers. So they have to take measures. Then second line of defense is overall risk management. Third line of defense is audit and controls. Okay. So internal audit. So when you talk about internal controls, that's a significant element of risk management. I think you saw last week when we discussed about internal limits as a measure of risk management. Internal controls. So internal controls are dominant part of the risk management framework. I think you recall last week lecture. Control activities, remember? So we discussed 8 components of our enterprise risk management framework. You can go back and see. There are 8 components: internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication monitoring. So control activities play. Here, control means the internal controls mainly. Very important. So when you see in your institution, you don't have either controls or you have poor controls, definitely it is a possible indication of future risk event, even resulting failure. So pay attention to the internal control framework in your institution. Okay. Whether you have limits in place, whether you have passwords, correct path. If you look at some systems, password, vault management. So there are 2 keys, which is related to the second point, the next point we are going to discuss. So internal controls plays a prominent role. Next, absence of segregation of duties. This again related to the internal control, but important element. Now again, I will discuss a little bit in detail about Barings Bank collapse later. Now, if you look at Barings Bank collapse, these 2 are prominent reasons: the internal controls and segregation of duties. So what do you mean by segregation of duties? Any ideas? Can anyone give example? How, what are the risks? Segregation of duties. How in your banks or financial institution this task works? Or key areas of segregation of duties or internal controls are in place. Can you give me example of your own institution, your own bank?
In treasury function, this front office, middle office, and back office can be taken as one example.
Yeah, can you speak a little loud too?
In treasury operations,
Yeah.
front office, middle office, and back office can be taken as segregation of duties.
Yes, yes. Okay, thank you. Any other thoughts? Any other views? In your own institutions, any areas of these two concepts are working? And you have seen some failures due to issues or absence of these controls or segregation. Have you experienced anything like that? Any other? I think, of course, I don't know the name of the lady who spoke now. She's correct. But any other views? Hope you are in the lecture. I don't know. This is the problem when you have online sessions. Anyone else? Yeah, I think we want to be this session be more live. You know, I can talk and finish it off within 2 hours. But
yes, sir, we are with you.
Yeah. So, any other thoughts? Anybody can express your experience in your institution with respect to these two concepts, or any events you have seen, or any failures within the institutions due to these issues like internal control, segregation of the. And she came up with a wonderful idea. One of the important elements of treasury framework is that you have a separation. Now, some institutions you have 3 separation, like front office, back office, middle office. But some it's front and back, or front and middle, or whatever. So the idea behind treasury operations is that segregation of duties is a purely one element of internal controls. Because if you look at treasury operations, the treasury, the buying and selling of treasury products are basically a job of front office. Okay.
So segregation between middle office, business, and risk management of a bank?
Yeah. So middle office basically risk management. So the risk managers cannot do the job. I mean, the traders are the people who engage in the trading business. So they are working at the front office. So if the traders themselves used to look at the risk and take decisions, so there's a clear conflict and failure of internal control. So that's why in all banks or many institutions, there are 3 separations or sometimes 2. So front office is totally segregated from middle office or the back office. So the middle office people look at risk. So they are totally independent. So they perceive these are the risks that could take place, and they discuss with the management and tells exactly these are the measures you should adopt, and based on your practices. So basically, you have to you are guided by those controls. So so if you look at, so that's a prominent segregation you will find, and also internal control you will find in a treasury operation of a bank. Any other things that you see? I mean, these are there in your own environment. So can anyone else do a couple of examples?
The business and the credit, the business people, they bring the business, and
yes.
the credit department, they evaluate the business and they take decisions.
Okay, so business people, you mean the marketing guys?
Yes, correct. Yes.
Okay, so that's again another way. So because the marketing guys, they do business, and they find customers, they market the products, but then evaluations are done by a different group,
Separate department. Yes.
Separate department. Some within that also there may be a segregation who evaluate. Is one set of people, and subsequent monitoring is by another set of people. So there may be sub-monitoring. So that's again another way of, internal control segregation. So these are, because if you look at these things, it doesn't mean all these things done by one party result in failures, but there's a greater possibility when all these functions are assigned to one group, the greater possibility of a particular risk event that could take place. So another couple of examples, if you look at your own vault, there's a dual control. How many of your banks have? I think almost of your banks have dual controls, isn't it? Okay. So dual control of keys. So if you look at a key vault, there are 2 key holders. So that's again, why not 1 key holder? Even like places like central banks, certain vaults are managed by 3 key holders. Because that's one of the important control aspect where to minimize possible risk. And passwords. How regular your institution change your passwords? How regular?
Once a month.
So once a month. Okay, so that's more frequent. So that again internal control. Even your own password, there's a possibility somebody can steal when you use it for, what do you call long period. So frequent changes, so no one can steal your own password. So again, password is an important element. So likewise, there are a lot of internal control, segregation of duties to avoid any conflict of interest or of risk event take place, so ultimately resulting in failure. Another clear problem has been clearly defined reporting lines. So that's again an important element. So what do you mean by reporting lines? Do your banks have clear defined reporting lines? Do your banks have clearly defined reporting lines?
Yes.
So what is the purpose of a reporting line? And if you don't have proper reporting line, what are the risks? How do you perceive the absence of a reporting line? Why do you think, it's a very important element of risk management framework, governance framework? Any thoughts, any ideas?
Absence of proper reporting lines can cause confusion and leads up to losses in business.
Yes. So the one important thing is when you have a clear reporting line, you know the authority levels, responsibility levels. But if you don't have any reporting line, basically you don't know what is the authority level you have and what is your responsibility and how it differentiates from the next line of reporting. Okay. So the chances of anybody taking any decision without proper risk management leading to failure is very high. So even if you look at business making credit decisions, there are different reporting lines. How do you report? And also different authority limits. So where you know exactly this is my limit and thereafter this is my reporting line. So everybody understand in advance this is my role and to whom I am reporting, to whom I can delegate my authority, so that it's very clear the decision making levels. And if you don't follow, it will make you responsible. So no one can, if something goes wrong, no one can pinpoint, problem on or the issue with another person. So it's very clear and everybody will report. So the chances of risk event taking place is fairly minimized. Okay. So it's very important. I think most of the institutions have organization charts. So where it clearly defines, the reporting lines and the authority levels. The next point, proper management information systems. Again, very important if you look at especially a banking institution. Okay. Because this is very important for a board or the senior management to make decisions. Because all the decisions you take either board level or the CEO level or the KMP level depend on the information given by your subordinate officers or information given from your system. So if you don't have a proper management information system which gives the right information, the entire decision making process is going to collapse. Because at the end of the day, how did you make decisions based on the information provided by your own system? So the information system does not provide the correct information, you end up with a disaster. Okay. So that's very important, because today's context, we are not guided by the manual information systems. So it's basically advanced IT-based information systems. Now, for example, let's say today, you want to take a decisions based on your liquidity of a bank. Okay, so the CEO wants to know exactly how much liquidity in my hand today for the next 1 year or next 2 months. So then he wants to get some information about today's position and forecast for the next couple of years. So the MIS you have comes with couple of numbers, and he's going to make certain decisions based on that. But after taking the decisions, 2 weeks later, you find some problems where the decision the CEO made, the company, the bank made 2 weeks ago based on the information provided by the system is not accurate. So that's very important. I think you have to regularly review your MIS to ensure the management information system provides accurate information required for decision making. It's very important. Then internal audit function. Okay, internal audit. So internal audit related to, again, internal controls partly. So internal audit is also important, because you see certain institution internal audit is not working properly. And also there is always conflict between the internal audit and other business managers. But what is important thing is, if you don't have internal audit, chances of even business managers getting into problems is too high. Because we should not think as internal audit from a police perspective, but what they try to do is to see whether you have followed the given procedures, policies, and your accounts or the financial statements have complied with the particular standards. And also, are there any material misstatements or problems in preparation of your financial statement? So basically, we need to have internal audit, active internal audit. But there may be internal audits within your respective bank, but they have to be very active, they have to be very experienced, and they have to come up with their own independent views and take decisions. So they have to have a clear plan. They must do audit frequently as per the plan, and they must come up with their reports properly on time with the suggestions. Okay, so those are a few important things, based on experience of failures that could lead to possible, risk failures in your institute. That there may be many more, but these are very basic broad things. Okay, so let's look at the persons responsible for risk management. So if you look at any institution, the board of directors has the ultimate responsibility for risk management and also to formulate a risk management strategy. Okay, so the ultimate the responsibility lies with the board of directors. Okay. So for each exposure, the director should decide whether they are prepared to accept the gross risk. They are not prepared to accept the gross risk, they should consider strategy for avoiding or reducing the gross risk through control or containment. So board's responsibility for risk management is a feature of corporate governance. So this again now links to the corporate governance. So in terms of corporate governance principles, their ultimate responsibility for risk management lies with the board, and they set the strategy and the framework. So basically, they set the strategy and framework. So, so they decide the whole risk management strategy and management. The people under the board who basically implement the strategy will formulate and detail strategy and will be responsible for an accountant for maintaining and monitoring the control. So basically, once the board sets the strategy, the management will have to implement it and monitor it, and they are responsible and accountable for any risk failures. So in practice, the chief executive will usually be given the responsibility and will delegate responsibility to other executives. So basically, once the board set up the strategy, the responsibility mainly lies with the CEO, and then CEO will route to the respective other executives, maybe chief risk officer, or maybe risk committee, again maybe a board committee, or any other executive who need to look at look at the implementation of the strategy. So when you develop the framework, there are questions you should ask, because even within a board, even among yourself, you may not know everything, because knowledge of risk vary depending on the person. Okay. So otherwise, the risk management framework you ended up with, that you come up with, does not cater to your own requirement. So it's very important when developing framework to discuss among yourself possible questions. For example, do we understand our major risk? Do we know what is causing our risk to increase, decrease, or stay the same? So one typical question you can ask among yourself as a part of people involved in this framework. Do we know? Ask yourself, what is your, what are my risks? Okay. So do we know what can cause to increase it, decrease it, or stay at the same? Have we assessed the likelihood and impact of our risk? So once we understand the risk, a possible question, okay, people come, okay, we have these 10 risks. Then have we done an assessment of likelihood and impact? Because all these 10 risks you identified may not have the same likelihood and same impact. It's different. Remember, we discussed the risk matrix. Importantly, have we identified the sources and causes of our risk? So have we identified the sources and causes of our risk? It's very important, because if we don't know the sources and causes, how we are going to manage the risk? How are we going to manage the risk? You see? Like COVID, you know the risk identified. So we have assessed the likelihood and impact. So what are the sources and causes of our risk? So sources is like, sneezing by, somebody, who has already infected, sneezing, and whatever the air droplets coming out, maybe in the air. So, and if we are close by, we are exposed without wearing a mask or whatever, then we would end up with the resources and causes. Okay. How well are we managing our risk? Because the important thing is we can't stop things happening. Can anyone in this now, if the, even, you see how badly COVID affected in developed countries. Would any one of them stop that happening? No. So we can't stop any risk event taking place. But what is important is, once we assess, identify possible risk event, then we have to have good management systems. We have to manage them in advance. So how well are we managing our risk? Are we trying to prevent the downside risk from happening, or are we trying to simply recover from them? So are we trying to prevent downside risk? That means the risks which lead to losses and failures. So what are we going to do? Or simply trying to recover from them. Who is accountable for these risks? So it's an important element. Who is accountable? Okay, so it's very important to identify people accountable for these risks. Okay, whether they have done their job, or if they don't, what action we are going to take. How do we talk about risk? Do we have a common language across branches, across divisions, across the system? So, different people look at risk differently. Even among yourself in a bank, some people take it very simply. Some people take very seriously. So there should be a common language. Anybody can understand to discuss risk within your bank, within your institution, across branches, across divisions, across the system. Because certain things you look as risk may not be the same way another person look at in your branch. Okay. So you have to have a common language. Are we taking too much risk or not enough risk? Now, when you take your businesses, I don't think any one of you could do business without taking risk. You have to take the risk. If you don't take the risk, you don't have any businesses. So if you want to earn interest income, you have to lend. But lending always associated with the credit risk. So if you don't want to take risk, then forget about doing lending business. So that means you don't need a bank to do that. So what is the mix? What is the balance? Are we taking too much? Are we not taking too much? So you have to identify that. Are the right people taking the right risk at the right time? So whether the people behind taking risks are the right people, and whether risks they took are right, and whether they are taking at the right time. It's very important. What's our culture? Are we risk averse or are we risk takers? Or are we somewhere in between? So again, the culture behind your bank, your financial institution. Remember we discussed risk averse people, risk lovers, risk neutral, and so on. So are we risk averse? So it should be not adverse in the note, adverse, or are we risk takers? Or are we in between? So what's our culture? So when you design your framework, you must identify your culture. It may not be the same with another institution. Because the risk framework, how you're going to address the risk, depends on your culture. Depends on your culture. So these are some, questions that anybody would ask when think about developing a framework. Any questions? No? Okay. So let's move on to the risk in banks and financial institutions.
Excuse me, sir.
Yeah.
So in the previous note, it was risk adverse and risk takers. Does risk takers means risk neutral?
No. Risk takers, no. Risk takers means not risk neutral. I know who will take, could include even risk neutral or risk lovers, both. Because who doesn't care about the, risk, basically. That is, takers even can think about risk neutral people, because now risk neutral people, they don't bother about the risk. They purely go by the return. Okay. So that's also risk taker. He doesn't take the risk into account. He purely go by the return. So whether the risk is high or low, he only look at the return of a particular, transaction. Risk lover, he is a person who bet on both sides. So he take into risk, but again return. So he know this is a high risk event, but I can end up with a higher return. So he basically goes by, he look at the risk, but he also look at the return. So it doesn't matter whether risk low or high, but he is purely go by the return compared to the risk. He knows that risk is high, but he knows return is also high, so he go by that. Risk neutral person, he doesn't worry about risk at all. He doesn't look at risk, but he is purely going by the return. Okay. So risk taker, you can consider as a both, because he doesn't, worry too much about risk aspect. His main concern is to make the maximum return as possible. But risk not adverse, it should be risk averse. Risk averse person will go by the fundamental risk return concept. Like what we discussed last week, 3 projects or 4 projects. So he will look at the risk, he will look at the return, and he will look at both and take the appropriate decision, but not just the project giving the highest return. Okay, but risk neutral person look at the highest return, irrespective of the risk is there or risk is not there. Any?
Okay, thank you, sir.
Any other questions? Anything else? Any other clarifications, please? Okay. So let's move on to the risks in banks and financial institutions broadly. So far, we have discussed in broad sense for any institution, what is risk, what is uncertainty, how do you build a risk management framework, especially the ERM, Enterprise Risk Management Framework, and the components of it, and what is the relationship between the governance and the risk management. Now, when you talk about banks and financial institutions, now, why risk is important? Why risk is important is a very important factor. Okay. Now, when we talk about a financial institution and banking system, we talk about a very specific risk, what is called systemic risk. Remember, not systematic risk, systemic risk. How many of you heard about systemic risk? We know systematic risk. Systematic risk. Anyone heard about systematic risk? So what is systematic risk? I think as bankers, as people engage in different businesses, trading, should know about systematic risk. So don't confuse with systemic risk and the systematic risk. What is systematic risk? Anybody? So what is systematic risk?
It is the unidentifiable risk that is inherent to a particular market.
So can you repeat it again?
It is the undiversifiable risk, sir, that is inherent to the particular organization or the market.
Okay, okay. So right. So when you do investments or whatever in a market portfolio, it is the risk arising from the market. Okay, we call systematic risk. So what is the other thing coupled to that?
The unsystematic risk.
Yeah. So what is it?
That is the macro kind of any organization cannot control. It is coming from the outside, so it cannot be diversified.
That is the market risk.
Yeah.
Yeah, but
Systemic risk that is coming from macro variables, sir.
yeah, unsystematic risk is basically is relevant to the specific institution.
Yeah.
Where you can take measures to control it. Okay. So systematic risk, when you talk about systematic risk, that is something coming from the market. Okay. So if you look at risk return trade-off, we talk about beta factor. Okay. Remember, what is the beta factor? Is the beta coming from market, which you can't do anything. What is happening in the market, you can't control. You can't control market. Okay. But what you can control is on the institution you going to invest. So that is called this unsystematic risk, which is inherent to the institution. So those are the systematic risk and unsystematic risk. Firm specific risk, market specific risk. But systemic risk is the failure of one institution in the industry threatening the stability of the whole industry. Systemic risk impacts the macroeconomy, resulting in failure of several other institutions and spreading it to whole industry. Systemic risk is greater when different institutions within the system are highly interdependent. The institutions are closely interrelated through their transactions with each other. So if you look at the banking industry, this is very important. For financial institutions, this is very important. Why? Because if you look at banking system within any country is highly interconnected, okay, interrelated, okay. So if there is a failure of one institution in the industry, it could lead to a possible failure in another institution in the industry and likewise leading to failure of entire institutions in the industry. Okay. So this is what we have seen during many financial crises. So the crisis start with a failure of a particular institution, which leads to failure of many other institutions. So what does it tell us? Let's say we have 5 banks in our system. Bank A fails due to inherent problems within the bank A. But if you look at BCDE, bank B, C, D, E, you don't have any problems. But still, the failure would threaten the survival of other institutions as well. So which is called the systemic risk. And the danger is it end up with a financial system crisis. So which could lead to an economic crisis. So that is the problem when we talk about systemic risk.
So can we couple this theory with
Huh?
2000? Can we couple this theory with the 2008 financial risk that the entire world faced?
Yes. So if you look at again, systemic risk. I think classic example is like main crisis now 2007-8. How it started, So what was the root cause behind failures that took place?
Subprime lending.
Yeah, subprime lending. So what is subprime lending?
Lending of below par, below quality lending.
Okay. So basically, if you look at countries like US, not like in our countries, there are two sets of banking institutions. Okay. Especially we call the tier one, let's say level one institution like our commercial banks, and level two institution like what they call mortgage, finance institutions. Okay. So basically, the business of mortgage financial institution is targeting, the lower end of the market, lower end of the economy. Okay. So like say, as you said, subprime means they are not the very prime customers. They are a little bit higher risk customers. But main products are mortgage lending, like housing products and so on, housing loans and so on. Asset-backed, loans based on asset-backed securities, which is very popular. So if you look at prior to 2007 period, there was a significant growth in consumer lending, like housing mortgages, consumer finance, and so on. Mainly by these level two institutions, okay, mortgage institution. So it's aggressive lending, significant growth in lending, okay, and which went to a, I think if you look at business cycles, always you see ups and downs in a business cycle framework. You have never seen it's a continuous upward trend or continuous downward trend. So in certain periods, economies are growing pretty fast and up to a particular level, then it starts bursting. Okay? Then you end up with a disaster if you don't control. So similarly, before 2007, there's a significant increasing growth or significant growth in loans, which led to a burst in 2007. So burst means it expanded significantly thereafter, when the economy is under recession, start bursting, because when the economy is in expansion, things are moving pretty fast, aggressively, without looking at risk. But after the peak in the expansion economy, the economy start coming down. So economy is going to a recession. Then what happens if you look at these mortgage loans, consumer loans? There was no underlying business in it. So then when the economy is going down, people also losing their jobs, losing their income. Then what happens? They can't repay their loans, and whether it's housing or consumer, they can't repay, so they start defaulting. So basically what happened in 2007, when the economy is towards a recession, people started defaulting, especially the housing loans and the consumer loans, and this institution led to a significant crisis. So then what happened? If you look at how these second level institutions funded their loans, so they were obtaining funding from banking institutions. So when the mortgage institution can't pay, then the loans obtained from banking institutions like even Citibank, large banks, went into trouble. Okay. Then, despite all these, there are certain institutions who are having bad risk management, bad governance, affected significantly than any other institution. Because all the institutions are going to affect in a crisis, but if you have good risk management, good governance framework, still you can face it. you can face it, and you can survive. But when you already have a bad risk management framework, bad governance culture, then in a crisis, you can't, tolerate, or you can face that. So definitely you are going to have a problem. So that is the second factor. So recession, the people who obtain loans started defaulting the, these second-tier banks, level 2 institutions, mortgage houses. Then they started defaulting banks like Citibank and large banks from which they obtained funding. And those institutions were having problems. And the next issue was that it did not have that, it had some impact on all institutions, but it did not end up with disaster for all institutions or failure in all institutions, because the institutions which were having good governance and risk management framework still could survive in a crisis. But of course, they had, adverse impact, like they lost their income, some bad loans and so on, but still they could survive. So that's a typical systemic failures. Okay, starting.
Excuse me, sir.
Yeah.
Excuse me. Is there any other industries which having this systemic risk other than banks or financial institutions?
No, I don't think, because if you look at, that's why. So this is the typically systemic risk is for specifically finance, because you don't see any interrelationship like banks in a any other industry. There is no typical interrelationship. This is directly related to the, if you look at the banks, there's interbank borrowings, interbank lending, and so on. So this industry, what do you call, this industry business is done with the public money. The risk arises because of you depend on the public money. Okay. So when you lose or when you fail, who fail? Public. Let's say take example of, even let's say tourist industry is going pretty bad, but not the entire system is going to collapse. Not the, public is, of course, there may be certain impact in the economy. Okay. But there may be certain impact to the employees, but not public. If you look at, a bank failure resulting systemic failure, it's a failure on entire public, entire depositors, entire payment system, okay, entire credit channeling mechanism. Okay, so that is the danger. So you don't see this systemic risk in any other industry. This purely, you may find certain, but it's not like what you see in banking industry or institution, financial institution. It's quite different, because, let's say maybe take manufacturing industry, producing what do you call some product, let's say cars. So there is a problem in Toyota company in Japan, internal problem. So does it mean is Nissan going to collapse? No. So due to a particular problem in Toyota company is going to collapse. But it doesn't mean Nissan is going to collapse. Okay. It doesn't mean what do you call Mazda is going to collapse. It doesn't mean Hyundai is going to collapse. No. Okay. Because there is no interrelationship. But in banking industry, let's say today there is a talk going on in Sri Lanka. X bank has problems. Okay, let's say today some news spreading. There's a problem in X bank in Sri Lanka, leading bank. So what is going to happen? What do you think? Definitely tomorrow when you start, now tomorrow is holiday, but let's say tomorrow is the working day. So definitely the message is going. What is the first thing going to happen? Tell me.
People will start drawing the deposits?
Yeah, today itself people start drawing their deposit from ATMs. It will start today. So there's some news spread, because within few minutes news will spread. Now today especially danger is we have social media, we have a lot of other channels where news can be spread within few seconds. what I'm saying, whether this right or wrong, right or wrong, there's a news going. So definitely. Then tomorrow when the bank opens, what is going to happen? What do you think? What's going to happen?
There will be huge queue for withdrawal.
Yeah, people will flock, come and waiting in the queue to get their money back, because definitely today ATMs will run out of cash. So what do you think? Can you give the money to all the people coming to the bank?
No.
No, you can't give. No, you can't give. You don't have liquidity. So you may try to either borrow from interbank system. What do you think? Your best friend in the bank B, who is in this group, okay, will he lend you money? Now you run short of money, so you ask your contingency planning, everything is in place. Okay, you ask for your other banks, other colleagues to help you. What do you think? Come on. What do you think? Probably you may go to central bank also, to the counter, and ask for money to a certain limit. But you finish that off also. Then what happened? Your colleagues will not lend you because they also know you are facing a problem. Because they don't put them into a risk by lending you. So there's a hold and people lose confidence. Then what happens? People start thinking, okay, now bank A has now collapsed. Let's say even central bank can't do anything. Okay. Then what is going to happen? The same day, people in the bank B doesn't have any problems at all. Bank B doesn't have any problems at all. What happened? People lose confidence and people start withdrawing their money, CD and so on. So naturally, there is no issue with BCD, but people now lose confidence. This is what I have highlighted in this slide.
So can we call this as a knock-on effect? Can we call this as a knock-on effect?
I can't hear you.
Can we call this as a knock-on effect?
Knock-on effect?
Yes. As
what do you mean? Knock-on effect means what? Can you explain?
When one bank collapses,
yeah, so that is called the systemic. Yeah, you are right. I don't know this word. So effect is you lose the confidence. Okay?
Right.
You lose the confidence in one institution, then it creates uncertainty in the minds of the people. Okay, uncertainty in the minds of the people. And banking business is the business which highly depends on public confidence. And one of the key elements of your business is high financial gearing. You are running your business with less capital and more outsiders fund. And you are exposed to significant mismatch in maturities of assets and liabilities, not like any other institution. Once you lose the confidence of the public, then because of your mismatch, you don't have liquidity and you can't repay the public money on demand. So leads to a failure of your institution, and then people start taking their money from the other institution as well. Because of the uncertainty. That doesn't mean that institution going to collapse, but there's a possible chance of that's being collapsed. So
excuse me.
Yeah.
Hello. So excuse me.
Yeah.
Do you believe in case of increase in a capital would make this comfort?
Yeah. So that's why it is very important you have adequate capital to manage risk, but capital alone is not sufficient in a crisis, because even you have capital in a crisis, what is the most important? It's not the capital. You may be very solid with capital.
It's the liquidity and it's the liquidity and cash paying out capacity.
That's right. The
In the bank.
liquidity in a crisis, most important thing is liquidity.
Yeah. So
You may have
what
a good capital, but if you don't have sufficient liquidity to ensure depositors are paid on demand, that is the only thing build up your confidence.
Yeah.
So let's say 50 customers in the queue today because of this news. You pay 50 customers. What is the message going to the others? There is no problem. I came to the bank, they paid me. So that gives the confidence to the rest of the depositors. Okay, I'm not worried. I'm not going to ask for mine. So, yes.
In case of a serious failure in the customer's confidence on the bank, right?
Yes,
Suppose the biggest banks in Sri Lanka, right? One of it, right?
Yeah.
If one bank is having a problem in terms of customers are giving for their own money taking, right?
Yeah.
Whether any banks have a sufficient money to pay it off, or
No, I don't think.
even with the support of central bank or whosoever, is it possible to pay off?
I don't think because there is no way, because if you look at the second point I have highlighted, because you are running with a mismatch of assets and liabilities now. Most of your assets are parked in not liquid assets. So they are parked as long-term lending products. So you can't call back to a lending products, no? Okay. So basically you don't have liquidity. Okay. If all depositors come at one time, even the best bank in the country would collapse. There's no issue, no question of it. Because even for central bank to help, you can go to the open market window and get some money depending on your liquid asset. But again, that is limited. If you look at your total balance sheet assets, how much you have in liquid form, very marginal amount. Okay, so basically, even if you go to the what you call central bank counter, again based on even for the if you want to buy from the bank at the bank rate. Bank rate again, you need some securities. Okay, so that is not sufficient. There is some serious intervention by the central bank to build up confidence, stop people who are paying depositors. Only way that central bank intervention where central bank asks to stop prepay depositors. Then no one can take deposits. That is the intervention. Other than that, if everybody comes under, there is no way any bank in anywhere in the world. In the 2007 crisis, how many times Citibank failed? 5 times. Failure means near failure. They lost. I mean, they ran out of funds. So it doesn't mean they were close, but they went short of funds, and ultimately they were into intervention. So that means even the best bank I'm not saying best bank, one of the leading banks in the world could fail. Okay, so that is the danger. Okay, because you are highly geared. Highly geared. Highly geared means you have more debt than the capital compared to any other business organization. Okay. Then
thank you.
Yeah. Then your maturity mismatch, because your liabilities. What is the nature of your liabilities? So what do you mean by maturity mismatch? Anyone had heard before? Anyone heard about maturity mismatch?
Borrowing for short term and lending for long term.
Exactly. So your liability side, if you look at your deposits and borrowings are mainly short term. Okay. So if you look at your banking structures, those who are working in bank, the maximum deposit product, majority of deposit products are less than 1 year, 3 months, 6 months, 1 year, maybe 2 years. And if you look at savings product, there is no maturity, it's only month. And your borrowings are limited, even if you have long-term borrowings. But if you look at your asset structures, assets are very much long-term, 2 years, 3 years, 4 years, 5 years. So there is a mismatch. So you have used short-term or very near-term funding to grant long-term loans. So your internal risk management, liquidity management only ensure you meet the needs of the depositors when they demand. But in a systemic crisis, you know, day-to-day basis, how much liquidity you need, because not all depositors are coming to withdraw their deposit. Even if you take FD holders, okay, FD holders, at the maturity, how many of they are withdrawing in a particular day? Let's say today, there is a 1 billion of term deposit maturing. So do you think all 1 billion will be withdrawn in your bank?
No.
No. So what is your experience, renewal of deposits?
It's 65 to 60 to 65 like.
Yeah. So basically that means, so 60 to 65 is going to renew it. So that's what you told, no? 60 to 65 renew it. So you only need to ensure the balance 35 is catered. So you need some funds to satisfy the needs of the 35% of the rest of the people who are going to withdraw. So by experience, you know, this is my withdrawal pattern. This is my withdrawal risk. So that you keep fairly adequate liquidity to meet those needs. But if everybody comes, then definitely you are in trouble, because maturity mismatch is significant in a bank. But that is the nature. You can't avoid. If somebody talks about opposite of this, you are not doing banking. Definitely. So if you do the banking, definitely maturity mismatch is there. But what is important is you maintain this at a comfortable level. So as a risk manager, when you look at your maturity mismatch profile, you need to ensure it is managed, it is, you know, maintained at a manageable level. So that is the part of the risk manager's job. We will discuss all these things later in our, you know, liquidity risk management part, but this is just in brief, okay? So the one major cause is financial gearing, because you do the business with others' money, and the maturity mismatch. Then the 2 points I said earlier, the confidence, public confidence, and uncertainty. So this is a very common thing. So if there is uncertainty, definitely people is going to withdraw the money, and then so that will lead to loss of confidence, and then confidence is lost means the people are going to withdraw the money, which could lead to a systemic crisis. So it's very important as bankers, you pay significant attention to these factors to ensure building confidence. Okay? If you look at many failures started from, you know, losing public confidence and also uncertainty, you know, fear. There is no necessity to have a problem. Have a problem. Now, let's say I will take a very classic example today. Now you are here in the IBSL. Let's say one of you go to this, you know, near this, what is called roundabout, near symmetry, and just, you know, talk, you know, the Ceylon bank, or, you know, let's say bank, I want to tell what you call a name of a bank. Bank A is going to collapse. You just, you know, tell openly. What do you think? You just say openly when, you know, what do you think? This particular bank is going to collapse.
Well, that's a strong statement.
Huh?
Strong statement that can go on.
Yeah, wrong statement. But I'm saying what's going to happen? Tell me what's going to happen. Statement is wrong. Yeah, but what is going to happen? This is the important thing.
Statements that will adversely. Huh? It could go adversely to the ear of the public.
Sorry? No, tell me exactly what is going to happen.
Public started to withdraw money.
That's right. So very first thing, because when, you know, couple of people going nearby listen to it, and then they spread the news. They say, you know, I saw somebody is telling this, and they immediately withdraw, and then they tell their, you know, whether you have, you know, they ask you, you know, if you know, your friends, you know, so basically they are not going to bother about clarifying that. So that is the danger. They are not going to bother about clarified. Immediately when you listen, the other person, if he has an account, he is going to withdraw from the bank, from bank A, and then spread the news. So definitely by the end of the day, there's a significant crisis. Was there any problem in the bank?
No.
When you make this statement, was there any problem in the bank? No, there was no
No.
problem in the bank. Just somebody went and made this statement, isn't it? So why it happened? Because that created what? Uncertainty in the minds of the people. I'll give a classic example. Now in Hong Kong, about 10, 15 years ago, there was a classic event took place. There's one leading bank, and that was a particular rainy day like today. Okay, rainy day like today. So yeah, even during that time, in Hong Kong, people usually don't go to bank to do withdrawals. There are a lot of ATMs in that particular bank, and so in a particular rainy day, there was, in one of the, busiest, cities in the morning, because of the rain, there was a bus stand near the, so there was an ATM machine in this particular bank, and right in front of this machine, there was a, what do you call, stand also. Now it was raining heavily. The people were under the, usually, not many people use buses, in Hong Kong, but because of the rain, there were a lot of people inside the bus stand, because the bus stand was very close to the ATM, like somebody moving outside, it appears like people are queuing to get the cash from the ATM. So let's say somebody moving on the road in a vehicle or whatever, it looks like there's a queue to take cash from this particular bank ATM. So usually you don't see big queues to take cash from ATM in a particular bank in Hong Kong that period, because there are a lot of ATMs. So this created a panic among people moving on the road. And the one important thing is, like Hong Kong people also, it appears they don't talk much with others. So they don't have to worry, you see. And then as time goes on, people started, they used to think, there was an uncertainty created in the minds of the people moving around. There could be something wrong in the bank, so I must take my money back. So you see, then these people started moving to ATMs. The ATM ran short of cash. Then news was spreaded around the country, and people started going to the counters inside the bank. So this took place around 8 o'clock in the morning. By 10:30, bank went out of cash and bank collapsed. So then they didn't have any cash in the vault. So Hong Kong Monetary Authority, the central bank, they called central bank had to intervene. They immediately closed the bank for the day. And then there were several communications to build the confidence of the people, saying that there's no problem in the bank. Bank was very well run. And then central bank pumped money and they started operations later. So what happened? Was there any problem in the bank? No, there was no problem in the bank. Because of that particular event, people just assumed things and acted. So that is the uncertainty. That's the danger. So today, let's say you go to a leading bank A. Today is a Sunday. I don't think you would see in Fort today, in a, let's say, Fort, busiest area. So in a Sunday, you will not see any queue. Let's say 15 of you wait in a queue near ATM. Do you know the result? Will you predict any result? What is going to happen? Same thing would happen here, because that's an unusual event. So you just wait, about 15 of your colleagues go to near the ATM, even to go to Boralla. So then people start thinking, in today's Sunday, we have never seen such a queue. Oh, something going wrong. Let me also join the queue. So not only I join the queue, I pass the message to others. So same result. So this is uncertain. So this is not a problem for any other institution, because there is no liquidity risk. They are not depending on others' money. So that is the danger. So the classic example I mentioned a little while ago about Hong Kong case as a classic example of uncertainty. So there was no problem in the bank, led to a crisis in the bank within a very short period. That is the danger. Okay. Any more questions? Okay. So let's look at briefly the integrated risk management framework for banks. We will discuss all those things separately in detail during the other modules, but the broad framework for banking system. Okay. Now, why we need a integrated risk management system in banks? What is the reason we need a integrated risk management systems in banks? For measuring and managing risk in an integrated manner to ensure comprehensive ICAP. So what do you mean by ICAP? Anyone of you heard about ICAP in your banks? Anyone? What is ICAP?
It's internal capital adequacy assessment process,
Yeah.
which finally bank looks at building up their own capital and way forward of how to align the bank's risk-based assets and the capital buffers.
Okay. So you are right. Basically, it's bank's own internal capital adequacy assessment process, where the regulators tell a bank to maintain a particular minimum capital, which we'll discuss in detail later in a module called Capital Adequacy Framework, where regulators set certain limits for the core capital and the total capital a bank should maintain. We call it regulatory capital. So that is the minimum capital you need to maintain. Okay, there are, depending on the bank size, there may be two ratios. So in addition, if you look at Basel framework, there is what is called Basel framework. We have three pillars. Pillar 1, Pillar 2, Pillar 3. The Pillar 1 is about this regulatory capital I mentioned. The regulators say this is the minimum capital you need to maintain. And Pillar 2 is called the supervisory review process. So supervisory review process, again, there are 4 principles behind that we will discuss when we look at that particular module. But where banks are now, the regulator has set a minimum, but regulator doesn't know in detail about real risk faced by your institution. So you are the people who are working inside the bank, or the risk managers or the board inside the bank knows very well the risk faced by your bank. So internal capital adequacy assessment process is a one where you do your own assessment on your own risk in detail. Risk means the risk covered under regulatory framework and risk not covered under the regulatory framework. If you look at Basel Capital Adequacy Framework, today under the Pillar 1, we are covering only 3 risks: credit risk, market risk, and the operational risk. But there are many other risks which is not covered under the minimum regulatory capital. So, as from the risk management point of view, when you look at the risk, you must do your own assessment about your own risk and come up with a number. let's say regulator say, okay, you need to maintain 14.5% of all 14% of total capital adequacy. So that's the minimum regulator say. But you are supposed to do your own evaluation and come up with, okay, a number which you feel comfortable. So how do you do it? Through the ICAP framework. So let's say based on your risk, you decide, okay, I need not 14%, 15%. So then you must maintain 15% because you feel if you don't have at least 15%, you are exposed to significant risk. So that is the objective ICAP. We will look at in detail when we discuss about Basel framework. So for banks to develop IRM techniques for monitoring and managing their risk and to ensure adequate capital is held to absorb losses arising from various risk exposures. So the IRM techniques are required to monitor and manage risk to ensure adequate capital is held to absorb losses. But at the end of the day, due to whatever the risk event resulting in losses to your bank, where do you absorb the losses? In your capital. So that's why ultimately losses are absorbed by capital. Okay. Now ICAP is something like this. Now when you are doing your advanced levels, and you are going for a class. So there are 40 students in the class. So master says, in order for you to get a B or A or whatever, you must at least study my subject 3 hours per day. So what does it mean? You must study my subject 3 hours per day, the master says. There are 40 students. So what does it say? Must say on average, at least you must study 3 hours a day, 3 hours per day. So what does it mean? So do you think if everybody sits and study for 3 hours a day, that is sufficient? Do you think that is sufficient? No. In this 40 group of 40 students, there may be very intelligent students as well as very poor students with, capacity to absorb. So what does it mean? If I am in the class, which I am not that intelligent, or I don't have that capacity to absorb, I may devote not 3 hours, I may devote 5 hours per day. Because what the master said was, okay, in general, at least you must spend 3 hours. So for me, 3 hours is not sufficient to get an A. So I must study 5 hours if I want to get an A, to minimize my risk of not selecting the university. But there may be another student, of course, even studying 2.5 hours, he still can do it because he's a brilliant guy, because he's a better risk manager. Okay. But the ICAP is a process where you do your own assessment, own risk assessment to ensure the right capital level above the regulatory minimum capital level. So when building your IRM framework in your bank, so what are the key things? Also, there are some guidelines issued by the central bank also with respect to the IRM framework in your particular bank. So basic to follow in building a framework. So probably you can have a look at those. If you look at central bank guidelines, probably you will have a detailed idea. So what are the prerequisites? So IRM framework should cover potential risks. So what are the potential risks you are going to face? Credit risk, market risk, liquidity risk, operation risk, reputation risk, strategic risk. There are so many risks your bank is exposed to. Possible sources of such risk, because for each bank, the sources may be different. So possible sources of such risk. So you have to identify the potential risk. What are the possible sources of risk? The mechanism, MIS, and reporting to identify monitor risk. Identify and monitor risk. So what is the mechanism you have in place in your bank to identify and monitor the risk. What is the MIS in your bank? Management Information System. Okay, to identify and monitor this, because certain risks are identified through the management information. Okay. Now, for example, how do you know the level of your credit risk? How do you know the level of your credit risk? Through the NPLs reported in your system, through the provisions made for the NPL customers, through the different categories of what you call delays in loan payment. Let's say you can, out of your loan book, you can say these much of loans are arrears for 3 months. These much of loans are arrears for 3 to 6 months. These much of loans are arrears for now 6 to 12 months. These much of loans are arrears for more than 12 months. So how do you get those information through MIS? So you have MIS which gives all this information. So when you look at those information, you can derive some numbers and you can identify potential risk. Then you can ask your respective departments to monitor them properly and take precautionary actions to recover loans, to reduce them being going pretty bad. So that's very important. Measures to control and mitigate risk at prudent level. So you must have measures to control and mitigate risk at prudent level. So when you set up the framework, you build, okay, when you see your NPLs going, now I'm just taking example of credit risk, beyond this level, you must take these actions, or you must limit, or when you see NPLs for particular sector is going above this, you must stop lend into that sector. So likewise within, different categories of credit, I'm referring only to credit here, you can have some. So likewise for any area of business operations, any areas of risk, you can have measures to control and mitigate risk at prudent levels. Officers and committees for control and mitigation risk. So you must, framework should identify who are the responsible officers. So there may be certain committees, credit committees, risk management committees, subcommittees to control and mitigate of risk. So as I said in a previous slide, who is responsible for the entire risk management framework? Who was responsible or who is responsible? Broadly.
Board of Directors.
Board of Directors. And once the Board of Directors set the strategy, the implementation rests with the CEO and the team. So you must ensure the involvement of Board of Directors. So they should know your framework. So without them knowing your framework, how they can ask CEOs to implement? They should jolly well know, this is my risk framework. So they have to approve the framework. The important thing is the risks are changing. The risk you identified last year may not be going to a significant risk next year. There may be a new risk coming next year. So you have to review the framework annually. Even the risk treatment process may be different. So you have to, you mean here the board has to review it annually. Assess integrated risk profile quarterly. So you must quarterly assess it. Okay, profile. Overall oversight of the implementation of the IRM framework. So basically the board is the ultimate responsibility to ensure the risk management framework IRM is approved, reviewed and listed annually. Reports are submitted quarterly for their monitoring and overall oversight of the implementation of the framework. Non-compliance, fitness and propriety of those responsible for lapses, non-compliance will be reassessed. So if you see KMP, so people.
Sorry to interrupt. Excuse
Sorry?
me, sir. Sorry to interrupt.
Yeah.
So someone has unmuted his microphone. Can you please? So it's difficult to hear, sir. what you are saying.
Sorry?
It's difficult to hear what you're saying, sir, because someone is unmuted his microphone.
Yeah.
Can you please
I think
ask?
it is better if you could mute, that means
Right
switch
now
off
it's
your
okay, sir.
speak.
Thank you.
Is it okay now?
Now it's okay, sir. Thank you.
Yeah, okay. So if you only want to ask a question, please, on your switch on your mic or unmute your mic. Otherwise, it will create a disturbance. Okay. Is that the thing that you wanted to discuss, or any other question? Okay.
No, sir. That's only.
Okay.
Thank you.
Okay. So, okay. Thank you. So non-compliance, you have to ensure, non-compliances are assessed properly. Okay. Then what is the role of board and senior management? We looked at the role of the board of directors. So let's look at the board and senior management role. The board is responsible for understanding and managing risk, promote a good risk culture with clear policies, procedures, and strong internal control. So you need to promote a good risk culture with clear policies. Policies are very important, procedures, and strong internal control. Remember, we looked at internal controls. Establish risk limits based on risk appetite. So based on the risk appetite, set the risk limit. Oversee the implementation of IRM by senior management. So you have to oversee the implementation of IRM, Integrated Risk Management Framework, by the senior management. Then in all banks, you should have an integrated risk management committee. Okay, IRMC. Okay. So it's very important. All of your banks have integrated risk management committee. So what is their role? Overall risk management should be assigned to the board subcommittee. Now, important thing, this is a board subcommittee, usually headed by board member. Headed by board. So board subcommittee means this board also take greater responsibility by appointing a board member to this committee. Then internal audit. So review the IRM process on an ongoing basis. So that is their role. So if you look at there's a role for the board to play, the senior management, the IRMC, and the internal audit. So what are the priorities in an integrated risk management framework? Architecture of IRM functions should be bank specific and depends on the size, complexity of functions, operating environment, and technical expertise of staff. Now, this is very important because you can't just build your structure looking at another bank. Now, let's say the People's Bank is in the process of building IRM framework. So People's Bank go and look at a bank like Union Bank. You look at the size is different, complexity is different, complexity of functions are different. Operating environment, People's Bank being a state bank, established for long years, large bank, their expertise may be different. And if you look at People's Bank structure, Union Bank structure, it doesn't fit you. So you must identify the right architecture for yourself based on these factors, your own specific factors, your culture, your complexities. The risk faced by the two banks may be quite different. Your appetite may be different. Operating environment. So you operate in a different environment. You go to the grassroots level. Okay. You may be serving very uneducated group, whereas another bank only target a different group, and also your technical expertise. All material risk and measurement tools should be incorporated. So all material risk and the measurement tools should be incorporated, as we discussed earlier. Stress testing and scenario analysis to be included. So another important thing is stress testing and scenario analysis. How many of you heard about stress testing or scenario analysis in your working environments before? Anyone? Have you heard about stress testing?
Yes.
What is stress testing?
Overseeing the possibilities, overseeing the projected possibilities that could occur in the future.
Okay.
Yeah.
Okay. Can you elaborate a little bit? Any further evaluation? Okay. So you are partly right, but you know, stress testing is you look at possibilities, you know, some possibilities that could happen in the future, and look at the impact that is going to happen, that's going to take place in your institution. Now, for example, I mean, these are based on some hypothetical scenarios. So stress testing doesn't mean that these are going to happen. Okay. For example, now your current NPL levels, you know, let's say 4%, but you predict a scenario for whatever reasons your NPL is going to rise for 10%. So if the NPL rise to 10%, what is the impact on your profitability? What is the impact on your capital levels and so on? So that's a hypothetical scenario. So what is important is when you do stress testing, when you see some adverse possibilities, okay, you can ensure you take appropriate risk management measures to mitigate such risk if that happens. Because if an event takes place, you can't do anything once it takes place. Okay, so you must try to avoid. So scenario analysis also same. You look at different scenarios. Stress testing also same, similar. You take stress event. Stress event. What do you mean by stress event? Some unforeseen bad events. Stress, we all know I am very stressed today. Little pressurized events, you know, pressurized event. So that is again an important element of identifying priorities. Okay, but then you must deploy fairly good, comfortable risk management techniques to manage such risk. The next element of IRM framework is risk aggregation and diversification. Now, if you look at the enterprise risk management framework, what is the key element of a ERM framework? Can you remember? What is the key element? What is the key thing we took into account in a risk management framework?
Identify.
Yeah, but yeah, any risk framework identify. But the key thing, we look the risk from entity point of view. Okay, because if you look at, there are a number of business units within a bank, but when we talk about enterprise risk management framework, we didn't look at risk in isolation. So we looked at, okay, there are different risks within business units, but how they affect the entity. Because if you look at certain risks in a one business unit, may be set off by another risk event in another business unit. So if you look at two individual business units, of course you see some risk. Okay, business unit A have this risk. Then we are trying to manage it. But on the other hand, there is another risk coming from another business unit in the entity, which itself can negate the risk arising from the other business unit. So you don't have to put a separate effort to manage those risks. So from an entity perspective, do you see any risk? Because one risk from the one unit can negate another risk. From an entity perspective, you don't have to worry. So that is the main advantage of enterprise risk management framework, opposed to a business unit-based risk management framework. Because we look at all the risks, the entire team is involved, and we look at the macro picture. So one important thing is the risk aggregation. So what do you mean by risk aggregation? Means take an entity-wide perspective. So you aggregate all the risk, combine all the risk across the bank and the business lines. But then you identified exactly what are the key risks faced by me, the bank, not the different business lines. So aggregation is very important. Be mindful of risk contagion. Addressing one risk may lead to raising of another risk dimension. So that's again important. Okay, so there may be certain risks when you address, trace other risk dimension. But when you look at holistic picture, you can avoid that risk contagions. Document decisions and assumptions used in risk aggregations. So you must document decisions and assumptions used in risk aggregation. So when you build up, you have to clearly set, okay, why you aggregated these risks and what assumptions you made. So anybody at a later stage look at risk, you know why this was done and whether assumption. Now, again, the question is when you review the risk management framework after 1 year, probably then you will see the assumptions. If there are deviation from what you thought at the beginning, then why that happened? Probably maybe due to some wrong assumptions. Wrong in the sense, weak assumptions. So that's very important, risk aggregation and diversification. Are there any questions? Because now next we move to credit risk management with details. So we will stop for a break for about 30 minutes and we'll start. So before we stop, are there any questions you need to clarify?
Hello, sir.
Yeah.
Sir, ICAP set out from tier 1 capital or tier 2 capital?
No, ICAP is a broad overall capital.
Okay.
I mean, you can look at the overall capital, like total capital adequacy. I mean, you can have your internal limits for, what do you think you need tier 1 capital and what do you need tier 2. But it's overall capital, ICAP is about overall capital.
Okay, sir. Thank you.
Any other questions?
The enterprise risk management framework example specific that then we will
I can't hear you. Some vibration.
Yeah, we can to our company or bank level.
No, I can't hear you properly. Some vibration came from your mic, I think. Can you repeat the question?
ERP framework, can you explain with an example?
Can anybody hear? Because I can't hear some vibration.
What she is asking, so what she is asking, whether to explain IRM framework with the real scenario, real world scenario examples. So
whether to
whether you can explain the IRM framework with the real world scenario, the real world example.
No, real world example mean it is. I mean, it is. You have to see how your institutions have built up the framework. But these are the concepts. What I thought was the concept that you take into account. But it's like it's your own document. So if you go to your bank and ask the risk management unit to provide you a framework, that is the real example. So I can't give a exact document of a risk management. So these are the broad principles which you take into account when you set up a framework. So if you want to see a real example, best thing would be to look at your own bank framework. So when you go to office, ask your colleagues to provide a copy of your own IRM framework. So that's basically the real document. So if you look at real world, take your own document. So these are things.
I believe she is not working for the bank. I believe that's a lady representing the university. I believe so. I don't know whether exactly.
In that case, definitely at least because
No, that's me.
Huh?
That's right.
No, sir,
Okay.
I didn't ask the question.
Okay, anyway, whoever, so if you want to
Yeah.
look at the real example is to get your own, I mean, whether you are working or not, ask somebody to get a real framework established by a bank, so which is not available with me. So that is only, so if you look at a real document, you will see how the framework has been established. So basically, what I taught you is that the things that you should take into consideration when you build up your frameworks. All these things so far we have discussed has built in. You know your priorities, the role, and the risk limits, and then risk mitigation techniques, risk matrix. All those things are there. Risk control, and all those are in a one set of document. So it's not real. If you somebody a real world example is the document. So they
Yes,
are.
I agree with you, sir, because I'm representing a little a smaller bank compared to the all other commercial bank. We are having a IRM framework, which is not much comprehensive compared to the BOCO commercial like. So we are having a IRM framework. That is aligned with our own risk profile and all.
Yeah, that's exactly right. No, because remember I mentioned that. Now if you look at IRM priority, look at this slide. Architecture of IRM function should be bank specific and depend on the size, complexity of functions, operating environment, and technical expertise of staff. Now, even technical expertise is a matter, because I mean, in a particular bank, there may be a very good experts in risk management, but another bank you may not have. So basically, the framework you build also take into account the expertise. I mean, you just can't build a framework if you don't have expertise. You should know what is risk, what are these controls. Otherwise, if you just have general background knowledge, you can't build a framework. You can't get involved. So that's very important. So bank, now you said your framework is very simple process. That's right, because based on your profile, your size, you may need to have a very comprehensive, lengthy framework. Okay, so which is fitting you. I mean, you should not waste your resources building a complex one, which may not really need. So that's like you build a house. So you have only 5 million rupees in your hand, and you can borrow 5 million. So you must build a house, and you only two in your family. So you must build a house to meet your 5 million ability, and just enough for two people. So another person has 50 million wealth. I mean, you can build still, even if you are two people, you can build a house with swimming pool, everything and also if you are more number, then you can go for that. So likewise, it depends on your nature specific, your ability to control them, your risk, and your culture. So a commercial like bank like BOC, PB, commercial bank, your functions are more complex. Operating environment also important, and the technical staff. They have very good technical staff. So so it's very important to identify your own environment, your own complexities. So it depends. If you look at two different banks, framework may be different. If you look at real examples, the only example is seen through your own bank, or maybe a bank which has set up a framework, how they have built it. But these, what we taught, was the key points that should be embedded in such a framework. If you look at a framework, let's say now, since you are working in a small bank, look at the framework and see how things we discuss has been addressed in your framework. Any more questions?
So usually, who are the members of the Integrated Risk Management Committee?
No, that now if you look at in a bank, definitely it's a board subcommittee. So board member is there. Okay, a board member is there. Then there's chief risk officer is there. Then sometimes
chief credit officer is also a member.
Sometimes depending on the banks, but the board member is there and chief risk officer is there. But if you look at the direction, there may be certain compulsory, positions somebody should hold, and then CEO may be there. CEO may be there, definitely.
Yeah.
And there may be other key important people you feel should be in the frame, committee. They can be there, but there may be other parties invited for the committee on invitation based on the requirement. But board, since it's a board.
Yes. Yeah, as per the IRM frameworks, I mean integrated risk management guideline. Apart from the board members, CEO, chief risk officer, are the key members. In addition to that, all the categories who are bearing, who are responsible for the risk-related area has to be members of the committee. Apart from that, the particular committee has the capacity to invite people based on the requirements.
That's right. So basically, the board member, maybe the chairman of the committee, usually, then the CEO, the chief risk officer, and people like CFO and like chief credit officer. And there may be like other line managers who may be invited depending on the need.
Yeah. So in the organization that I'm employed, the IRM committee is stuffed with head of wholesale banking as well. So I'm just thinking how risk and wholesale banking has something to do in tangent.
Yeah, because wholesale banking again related to credit, no.
Okay.
Yeah, it's wholesale banking. Is basically you may be referring to corporate bank. Yeah.
Yes,
correct.
So
that's again right read. I mean, certain banks, depending on the complexity, you may have corporate banking and retail banking separation. Some institution, depending on the company, you don't have corporate and separate corporate and retail banking. So definitely, if the corporate banking represents significant exposure in your bank, definitely. Because there's a significant credit risk, probably he could be a member. So definitely.
Right. Okay. All right, sir. Thank you.
Yeah. Any more questions? Anything else you need to clarify? Okay. So if you don't have anything, so we'll stop for a break. It's almost 10:40. And so we'll start at 11:10 after 30 minutes break. The rest of the, few slides. So probably we can finish it off early. So we'll start again at 10 minutes past 11. Okay, thank you. Okay, before we move on, are there any more questions do you need to clarify from what we discussed so far? Anything else? Basically, now today I will be briefly covering the introduction. So from next week onwards, Mr. Fernando will take over with the credit risk management module. So basically, the introduction is, we will complete introduction by today. And from next week onwards, you will move on to the main module of credit risk management by next week. Okay. Okay. So probably all these areas which I am going to discuss within next hour or so will be discussed in detail during those modules. But here what I'm trying to do is to give a brief overview about how those should be incorporated into a IRM framework. Okay. But the credit risk management in practice will be covered in detail during the next module, and also the other risk management, other risks which we are going to discuss here will be covered in detail in the other modules. Okay. So if you look at a bank, one of the most important risks faced by a bank is the credit risk. Okay. So if you look at a bank, there are different elements of risk. Broadly credit, market, liquidity, operational, reputation, strategic, and so many risks we can talk of. But especially if you look at a commercial bank, the main business of being lending, the main risk also faced by them is the credit risk. So what is credit risk, by the way? Anyone? What is credit risk, by the way?
Default risk.
Yeah, the risk of customer unable to pay the loan on demand, sorry, on sum and time, So if if a borrower from a bank fails to pay the agreed installment on time as per the agreed terms, then we call the credit risk. Bank is subject to credit risk. Okay. So what happens if the risk if continues to happen? So what is the ultimate result is when the borrowers start defaulting, it will have an impact on your profitability. One is when when the NPLs goes up, you have to make provisions for the non-recoverable or non-performing loans, which will have impact on profitability. Secondly, if the loans cannot be recovered further, you have to write off those loans again, leading to loss and profitability, finally impacting the capital of the bank. So if you look at credit risk management overall in point of IRM framework, so the oversight board approved credit risk strategy and credit risk policy. So basically in your risk management framework, you have to set the board approved credit risk strategy. Okay. And the credit risk policies. I think if you look at all of your banks have well-defined or developed risk policies. What are the policies you follow in your bank? Then second element is approved loan products and collaterals. Okay. Third is target markets and sectors. So within your credit risk policies, you have to identify what are the loan products you have taken into account or you think you will provide to the customers in your bank. These are the loan products. Maybe term loans, maybe leases, maybe import credit facilities, maybe export credit facilities, maybe packing credit. So there may be different loan products you have identified, which is within your purview of your policies, and also collaterals. Okay, so you must set different types of collaterals that you are willing to accept as a risk management tool when you provide a loan. Now that again depends from bank to bank, because now certain banks are very risk averse, so that they only grant a facility despite they assess all other factors. They need some collateral. They only accept particular type of collateral. So, for example, maybe cash-based, maybe government securities-based basis, maybe property-based loan, and so on. So you have to identify collaterals, because then it's very clear. You know, you exactly know, okay, these are the collaterals. So let's say somebody comes and asks for a loan product from your bank. Product is there, but let's say now you need to obtain a collateral in terms of policies. Then customer comes with a promissory note, for example. So let's say as per your collateral policy, you are not going to accept a promissory note as a collateral. Then you can't provide a loan. So the important is when you set the loan products and collateral, it's very clear. It's very clear your risk tolerances and risk limits, so that no one can deviate from that. If somebody deviates, you are violating. It's a non-compliance issue. So that is the beauty of having this framework oversight. Then target markets and sectors. So you define, okay, these are the markets I target. These are the sectors I grant loan. So you can't deviate from those sectors. Now, for example, a bank may identify, okay, for example, let's say tourism sector, the bank may identify this sector. I'm not referring to a turbulent time, okay, turbulent time, but the economy is doing well, but based on vulnerabilities in a particular sector, bank may identify I am not going to lend for this sector due to whatever valid reasons, okay, or there may be limits within the sector, okay. So let's say market. Now some companies, now if you take an international bank, when they grant loans, they not only grant in their local market, they expand to overseas markets. Let's say Citibank. Now Citibank, they do business in US market, they do business in Europe market, they do business in Asian market, they may do business in certain other markets, but they may define, okay, I am not going to do in South Asian markets because of whatever the reason, because it's risk appetite. So you have to identify. So no one can do business with those markets. It's very clear your market you are engaging, but and also the sector. So this is the oversight strategy, these policies, target loan products, and collaterals, the markets and sectors. Then what are the risk management tools you are going to have in place within your risk policies? So preferred level of diversification and concentration. So you must identify even sectors, okay, to have portfolio diversified among different sectors. Okay, you may have sector limits rather than concentrating on a particular sector. You may have, okay, I will be giving loans to manufacturing sector this much. Let's say import export trade this much, housing loans this much, housing real estate sector, then tourism this much, and so on. So you are basically diversifying. With the advantage of diversification is, even if this particular sector goes bad, have an impact, it will not significantly affecting your loan portfolio, quality portfolio, and you don't have a significant risk in terms of losses. But if you have a concentrated portfolio, like now, for example, take an example of recent bad experience from 2019, this Easter bomb attack. So one of the major sectors affected was the tourism sector. Again, consequent to the COVID crisis, again, tourism sector was affected. Let's say prior to Easter bomb attack, a particular bank has a 75% of portfolio in tourism sector. So what does it mean? They have not diversified their portfolio. So what happens if the tourism sector affects, then entire bank will be at a serious difficulty, serious problem. So always set preferred level of diversification and reduce the concentration. Then prudential limits. Already explained sector-wise limit. This sector I only grant loans up to this much. Then SBL. What is SBL? Is single borrow limit. Now single borrow limit also, within even a sector, you can specify the maximum amount granted to one party. So there is a regulatory requirement as well. But in addition to regulatory requirement, you can have your own limit, because that is a safe tool where if somebody goes bad, I am not impacted because I have a maximum limit for any particular company or individual, so that my risk is diversified. Single borrow limit. Ratios. There may be ratios. Okay. LTV. Now, what is LTV? Anyone? Loan to value ratio. Now, that is again risk management. Now, let's say this is specifically important in the case of like housing loans, the pawning, and so on. Now, if somebody comes to pawn article, so you may have a LTV. You say, based on the value, I am giving only 60% of the pawn value, article value. So that is a prudential limit. So that, let's say, Because why you need to have a limit? Because you have a collateral here. What is the collateral? Bond article, the gold article. But gold price may fluctuate. So when you give a loan to 1 year, let's say the bond article value is 60,000, but you give 60,000. What happens? Let's say gold value comes down and customer default, you are losing significant amount. So if you have a loan to value ratio of, let's say, 60%, so what does it mean? 75%. So if it is 75%, if the gold value is 6,000, you give only 45,000. So that basically reduces your risk even if the market value of gold article comes down. Similarly, housing mortgages, the property loans. It's a very important limit, prudential limit. Risk acceptance criteria and credit approval authority. Remember, I talked about line of reporting. So that's again, there should be a clear benchmark for anybody, any decision-making authority to decide whether I am going to grant a loan or not. And if granting a loan, what is the risk pricing? Risk pricing I am going to make. Okay. Then credit approval authority. It's very important. Now this is part of reporting line concept where banks set aside different authority levels based on the loan amount and the collaterals. You see all of your banks, to take a branch, branch manager cannot approve each and every loan. So there's a limit given a branch manager can approve, especially large banks. Then if there is any other size of a loan, it has to be after initial evaluation, it has to get the approval of the next level of authority. Okay, next level of authority. So then if it is further beyond the limit, then it has to go to the, like credit committee or the board committee. Okay, board level. So there are different approval authorities, okay, where a decision can be taken considering all risk factors. Okay. Portfolio management and recovery management. Again, important how you manage an entire portfolio. Now, when you grant loans, even though you grant loans for individual institutions, so ultimately you have to have an overall look at the entire portfolio, entire loan portfolio. Okay, broad view. And the recovery management. If something goes wrong, how we are going to recover. Okay. So you may have collaterals for that purpose, or you may have other alternative options. Then credit risk management practices. Example, single borrower reviews, annual customer and limit review, customer visits. That's again very important. What are the risk management practices? Now, in typical problems, the experience we have seen is that when it comes to lending, banks are very much forceful in giving a loan. When it comes to lending, you will try to give as much as loans possible. So once the loan is granted, to see whether the person or the institution who obtained the loan is doing the job he asked the loan for, it's not measured, monitored. So it's very important to do at least annual customer and limit review. Okay, so how the customer has been doing so far. So whether I can allow based on his performance, I maintain the same limit. Now take example of overdraft. So if you feel customer is having bad experience, may cause significant risk, probably you may reduce the limit. Customer visits. It's very important tool. What is he doing? Are there any problems? Whether he has obtained the loan for the right purpose. It's very important. Risk management practices. Internal risk rating grading system for pricing the risk. I think almost all of your banks have own risk rating or risk grading system for pricing the risk. Because when it comes to pricing of a loan, it's very important to identify the level of risk of a particular business entity or individual. So have an internal risk grading system in place so that because you don't get the same risk for people with same risk always. So there may be different risks. So how do you price them? It's different. So based on the risk grading system, some banks have A, B, C, D, E. So for the high risk customers, you have a higher risk price. Early problem recognition and watch list. That's again an important part of risk management for the credit risk management. Now, as you go on after lending, it is very important to monitor your portfolio carefully and identify any borrower which could, or with a probable risk. So we call watch list. So when you see in a portfolio, due to the pattern of repayment or due to many other issues you experience during the maybe 1 year period after giving the loan, so you can have a separate watch list. You can identify some customers or borrowers which could create possible credit risk. So we call watch list. So you monitor them more carefully, more frequently than other guys, because you divide risky customers and higher risk customers. So you have a watch list. It doesn't mean they default, but you feel, there could be a possible, non-payment risk from these customers due to whatever reasons you have identified during past period. Classification of problem exposures and remedial action. It's very important you set up the framework to identify problem exposures, classify into different categories, and remedial action. So, okay, so it's very clear, okay, if loan is classified to this section, this is the remedial action. Okay. If loan is classified to this section, this is a remedial action. So based on the classification of problem exposures, you have a different remedial action. Everybody has to follow that. It's very important. Because if you don't have something in place, it's very difficult to take, action. You don't know what to do. Now here what you have set this in your framework. You say, okay, the customer default 2 installment, this is the remedial action. Call him for a meeting, asking for a plan or whatever, Then if he continues to be in default for this month, this is the action. You send him a warning letter, okay? You ask for immediate repayment. So if the loan is non-recoverable for beyond certain period, okay, you you send a letter of demand, you file an action, you take parate rights, and so on. So it's very clear. Based on this classification, these are the remedial action. MIS and reporting credit risk data. Okay. So what are the credit risk important data which you need evaluating risk management? So management information systems in place to report credit risk data. Okay. So then exactly what is happening in your portfolio so that you can take measures. So in your risk management framework, you have to identify all these things very clearly so that anybody would know exactly these are the things I would follow, especially when it comes to loan defaults. In granting loans, these are my limits. Okay, these are my approval authority. Okay, these are the collaterals I should obtain, and so on. Any questions? Anything? No. Okay. So let's move on to market risk management. Now, what is market risk, by the way? Can anyone tell what is market risk? Anyone market risk? No? So I think all of you know credit risk, but no one knows market risk. So basically market risk is the risk of the value of changing value of assets and liabilities in a bank balance sheet or interest income. Okay. Sorry, or income due to the changes in prices of market variables. So remember. So when you talk about market risk, with respect to a bank, we look at 4 areas: interest rate risk, the foreign exchange risk, equity price risk, and commodity price risk. So those are the broad 4 elements of market risk, which we discuss in detail later. Okay. So market risk, the risk of possible declining value or change in value of assets and liabilities in the balance sheet, and also its impact on the income of the bank. Okay. So 4 components: interest rate risk, foreign exchange risk, equity price risk, and the commodity price risk. So those are the 4 components. So again, if you look at market risk management framework, we have oversight, board approved market risk strategy and market risk policies. So same like credit risk. So board has to approve what is the market risk strategy the bank is going to follow and what are the policies in place. Then approved products and counterparties. Okay. So like approved loan products and counterparties, interest rate related, FX and equities. Now here I said typically like countries like us, we don't have much commodity price risk because we don't, our banks, we don't do any commodity trading in our banking systems. Okay. Now typical commodity related market risk is the gold related, but I don't think any of your banks do gold trading. Okay. You may have a hold of gold stock, but not do gold trading, buying and selling. So basically, typically it's related to interest rate, FX and equities. So in your policy, you must have approved products and counterparties. So these are the products I'm going to engage in trading. Okay. And also counterparties. You must set like sector limits and so on counterparties. Okay. Because it's very important, counterparties. When we talk about the market risk, because especially certain are not just confined to your countries. You trade with other countries, okay, other markets. So the ALCO. So what is ALCO? Asset and Liability Committee. So what is the role of ALCO, Asset and Liability Committee? What they are supposed to do? What is their, business? Okay, what is their TOR? Okay. And the risk management. Again, risk management, treasury function and controls. Very important. Previously, we discussed about internal controls and segregation of duties in a treasury function. Somebody mentioned. We have the front office, the back office, and the middle office. Okay. So it's very important, the controls in place in a treasury function. Again, prudential limits. Okay, very important. When it comes to trading, set prudential limits. So you know, these are the limits within which I have to operate my business. What is NOP? Anyone? NOP?
Net open position.
Yeah, not open position within a given day, overnight. How much you can keep without covering? Okay. Net open position. Gap limits. So what are the limits in certain gaps, prudential gaps? Treasury operation limit. Now, for example, treasury operation limit means it could be a trader limit, it could be a daily limit, intraday limit, interday limit, a country limit, counterparty limit. So there are different limits within which a treasury operation take place. Now, for example, one particular trader is given a particular limit. Let's say you can only let's say Forex, you can only transact up to 2 million worth of transaction for okay. Sorry, there was a power failure, so now it has been restored. All of you are there, or
Yes, sir, we are there.
yeah. Sorry.
Yes, we can hear you now.
Power failure, and now it's been restored. Okay, so basically, the treasury operation limits, as you know, different limits, intraday limits, trader limits, counterparty limits, and so on, to avoid any excessive risk taken by an individual or to a particular sector or to a particular country. Okay, so everybody know this is my limit within which I should trade. So this is the limit when I do transact with the counterparty. So I can't deviate from that limit. Then value at risk limit again is very important. Value at risk, we will look at value at risk a little later when we look at market risk in detail in our module. So again, for a given confidence level within a particular period, how much I am exposed to. Okay, so then I set a limit. I should not expose beyond this much. So anybody will know, okay, I have to take some measures immediately if I am going to exceed the value at risk limit. Especially important when we talk about market risk, the FX risk management, because FX risk is significant, like countries are because we are depending on, because our currency is not international currency, we highly depend on international currencies. Okay, so what is happening in any other country now? If you look at US dollar, so what is happening in US is very important to our risk management when we have exposures in US dollars. So similarly, sterling pounds, euro, yen, and so on. So what is my risk management strategy when it comes to foreign exchange risk management? Foreign currency liquidity risk management. Again, when you talk about foreign exchange risk, like domestic liquidity, even foreign currency liquidity is very important. When I have in my bank foreign currency assets and liabilities. Okay, so I am going to manage foreign currency liability liquidity. Okay, to meet the demand of the providers of foreign currency funding. So again, foreign currency liquidity risk management strategy. What is my strategy? So those are to be built into the risk management framework.
Excuse me,
so then we'll move on to the operational risk management. So by the way, before we start, what is operational risk?
Excuse me, sir.
Excuse me, sir.
Yeah.
Sir, can you explain FX risk again? Because there was a connection issue for me.
Okay. Foreign exchange risk is the risk of your value of the foreign currency, net value of the foreign currency exposure going down as a result of changes in the foreign exchange rate. Now, for example, let me put this way. So let's say you have a foreign exchange portfolio in US dollars. So you have US dollar assets in your portfolio and US dollar liabilities in portfolio. So you can have a net position in your portfolio. Assets minus liability is called the net position. Okay. So whenever the US dollar rate against Sri Lankan currency increase or decrease, what will it result in? Your value of net open position will be affected. Okay. Isn't it? So you have a foreign US dollar assets and US dollar liabilities, and you have a net open position. So when the exchange rate appreciates, now we say the Sri Lankan currency appreciate or depreciate again US dollar. I'm only talking about US dollar position. So let's say you have a US dollar position, and position means assets and liabilities, and US dollar appreciate again Sri Lankan rupee. US dollar appreciate against Sri Lankan rupee, or otherwise Sri Lankan rupee depreciate, then how it affect your position in US dollars? How it affects?
Hello.
Yeah, how it affect?
If we have more assets in dollar terms.
Yeah. So you have net asset, we call open position is positive.
Yeah, then
Positive
of course.
Open position, because you have more assets in US dollars than liabilities, net open position is positive. We call positive gap. Okay.
Yeah, then of course.
Yeah. Yeah, you can explain. Yeah.
Then of course our value, rupee value is going up.
Rupee value is going up, exactly. Now there, Sri Lankan rupee depreciates is good or bad?
Good.
Good. So basically now, why? Because we have a net open position positive. Remember that.
Yes.
So remember the risk is different depending on the position and depending on the fluctuation of the exchange rate. Now the same example, you have a positive open position, that is you have more US dollar assets than liabilities. US dollar depreciate against Sri Lankan rupee. Then what happens?
Our asset value go down.
Yeah, we have a more impact on asset value than the liability value. So we have a negative impact. So the overall value will decline. So remember, so when we have a positive open position, the increase in US dollar will have a positive impact. Decreasing US dollar have a negative impact. So alternatively, when we have positive open position in foreign exchange, appreciation of US dollar, appreciation of Sri Lankan rupee will have a negative impact. Depreciation of Sri Lankan rupee will have a positive impact. Remember, so let's say our foreign US dollar position is negative. Now earlier we took a US dollar position is positive. So US dollar position is negative means what? You have more US dollar liabilities than your assets. So you have a negative position. We call negative gap. So if you have a negative gap in your US dollar position, when the US dollar appreciate, what happens? Impact positive or negative?
Negative.
Negative, exactly. Impact is negative. Why? Now you have a negative position. When US dollar appreciate means Sri Lankan rupee depreciate. Now problem is we have more liabilities in terms of Sri Lankan rupees. So we have a negative impact. Of course, opposite happens if the US dollar depreciate. Why? The US dollar depreciate means Sri Lankan rupee appreciate. So our position is now negative. So you get a additional benefit from the appreciation of Sri Lankan rupee or depreciation of US dollar. So you have a positive impact. So that is the basically foreign exchange risk means. So when you have a net open position in your foreign currency, particular foreign currency, the fluctuation in the exchange rate with respect to that particular foreign currency will have a positive or negative impact. So that is the reason. Similarly for any other currency, yen, sterling pound, euro, whatever. So that is called the foreign exchange risk. Now this is especially important because you have to settle, your liabilities, and you have to realize your assets. Now why this is important? Now take a practical way of looking at it. Now let's say an importer. Now importer who is importing some goods, okay. Now he has to settle his dues to the exporter in, let's say he's importing from Europe. Now he has to settle for the imports in 3 months for his imports in euro. Let's say 10 million euros. So what does he do usually? What does he usually do, importer? He is also a risk manager. He is also a risk manager. What is risk to him? Now, importer who imports something in 3 months need to settle 10 million euros in 3 months' time. So what is the risk to the importer? Is there any risk to the importer?
Yes.
So what is the risk?
The exchange rate can, exchange rate can fluctuate within the 3 months.
I want exactly what is the risk. What is the exact risk to him? What is the exact risk to him?
Risk.
Huh?
Exchange risk.
Yeah, but exactly now here I have given a specific problem now. In here I know exchange rate, but what is the problem here? Exact issue for him.
He needs to pay more dollars or whatever the currency.
Sorry?
He needs to pay more dollars or whatever the currency that he's supposed to pay.
No, but I said no. He wants to settle euro 10 million.
Needs to pay more rupees converted into euros.
Exactly. So basically in 3 months time, now today let's say euro rupee rate is, let's say euro rupee rate is 200. Let's say today. Now in 3 months time, okay, now how he settle 10 million euros? Because he has to give equivalent Sri Lankan rupees to the bank. Okay. Now in 3 months time, if the euro goes to 210 against Sri Lankan rupee, he has to pay how much to buy 1 euro? 210. So he has to give more rupees now. So that is the risk he faces. But whether he buy today or 3 months time, he get the same euros, isn't it? So if he pays today euros, he has to pay at 200, but in 3 months time, if the exchange rate goes up, euro appreciate, he has to pay 210 for buy 1 euro. So basically 10 million into 10 means what is the risk to him? He has to pay additional Sri Lankan rupees how much? 100 million. Because for one euro, he has to give 10 rupees additional. So what he does? So he has risk what he does.
So he can enter into a he can enter into an agreement with the bank.
Yes.
A forward contract.
Yeah. So what he does is, you are right. He will enter into a forward rate agreement, forward exchange rate contract with the bank to buy euros in future at an agreed rate. Let's say he comes to the bank and bank say, okay, dear, I will sell you foreign exchange forward contract in 3 months at 204. Let's say. So the bank agrees to give him dollars at 204 based on a premium. Okay. So it's not so basically now whether exchange rate goes up to 210, 11 or whatever, he has to pay 204. So what is the risk to the bank? So is the bank is safe now? No, because bank is also at a risk now. Because when the bank agrees to give me at 204, so bank has to buy in the market at 204. Isn't it? But whereas the current rate is 200. So when the bank enters into a forward contract with customer, so bank creates a liability position. So when the liability position bank holds, the fluctuation of, unless it has sufficient, what you call assets, foreign exchange assets to support it, fluctuation of the euro will have a problem with the bank. So that is the risk faced by the bank. Now the trader has mitigated his risk passing the risk to a bank, but then bank has to ensure bank is not subject to risk. Okay. So that is the danger of the market risk, foreign exchange risk. Okay. So we'll move on to the operational risk management.
Excuse me, sir.
Yes.
So the forward contract comes at a cost. That, I mean, that's number one.
Yeah.
The customer will have to pay a fee for that. And number
Yeah,
two, it can be vice versa as well. The customer can benefit out of it, or the customer can get into a loss as well, isn't it?
No, because in a forward contract, there is no loss to the customer. Because what the forward contract does is, customer's position is ensured. Whatever the market rate, there is no loss to the customer. Because forward contract ensures this is my position, whether it's positive or negative. Okay? Because it makes me certain. Now, let's say I know what you mean. Because let's say the euro appreciate. Sorry, euro depreciate. Then the simple argument is, why did you enter into a forward contract? Okay? If the euro depreciate, what happens? Sri Lankan rupee appreciate means I have to pay less rupees now. But since I have a forward contract, I can't do anything. No, objective of a forward contract is not that. Objective of forward contract is to make sure that I am going to pay so much. So it doesn't mean I am losing, because I know today, whatever the market foreign exchange rate, whatever the exchange rate in the market in 3 months' time, whether it goes up or down, I am going to buy euros at 204. It may be 190, it doesn't matter. It may be 250. So when you talk about a forward contract, it only makes the event certain. Okay. So you can't look at the downside or the upside risk, because I know exactly I am ready with 204. Sometimes, I mean, you can think it's a loss if the Sri Lankan rupee appreciates.
Okay, sir.
But he has to pay a price for that. That's right.
Okay, sir. Thank you.
Any other queries? So what the bank can do? Bank can again enter into a forward contract with another party. Now for the customer, what did you do? He entered into agreement to buy, isn't it? So bank enter into agreement to sell. Now bank is at a risk. So what the bank can do? Bank can again enter into agreement with another bank or another party to buy. See, so that's how the bank manages the risk. You see? Okay, so let's move on to the operational risk. What is operational risk, by the way?
Losses arising due to the failures in internal systems, procedures.
Okay. Again, risk of loss arising from failures in internal system, processes, people, or from external events. So the operational risk is risk of loss arising from failure of internal system, processes, people, or from external events. So there are two categories of operational risk which could derive from internally as a result of failure of people, failure of systems, failure of processes. Secondly, from external events. Now, a classic examples of your system failure, where you completely lose your loan system due to whatever problem, So you lose your system. You can't operate the system. Then process. There is a failure in process which led to a fraud due to the procedural weakness. Employees, internal employee stealing the money or hacking the system, stealing password and engaging fraud, or from external event, cyber attack, or external fraud, or disaster like earthquake resulting in your entire system going bust, tsunami, or anything. Okay. So it's very important that bank have a proper risk management framework in place to cover up operational risk. Now, if you look at 50 years ago or 40 years ago, operational risk was not discussed in detail. So that was not that important that time. But especially the bankers, regulators started discussing operational risk when it came to the failure of Barings Bank in 1996. So that's why in the Basel II framework in 2004, they introduced capital charge for operational risk. So if time permit, I will explain the Barings Bank, what happened later. Let's move on to the framework now. Oversight, like credit and market risk, again, board have to have operational risk strategy and policies in place. Then risk management. Internal control function, very important. As I said, that when you talk about operational risk, most important factor is internal controls. How appropriate your or how best internal control system in place in your bank. General compliance requirement, certification, general compliance requirement. Okay. Operational risk committees like credit risk committee, market risk committee, operational risk committee. Okay. So then internal risk factors, complexity of structure, nature of activities, quality of personnel, organizational changes, and employee turnover. So you have to have identified internal risk factors. Okay. Now, even, now here it has been mentioned employee turnover. Now, what do you mean by employee turnover? What do you mean by employee turnover?
Frequency of employees leaving your company.
Yeah. How frequently people are leaving, moving, and moving means leaving and joining the company. So when you see, so is it important thing? Let's say many people are leaving the company means higher employee turnover. So does it indicate some signals? Are there any signals depending on the number? If the turnover high means people are moving very fast, like moving here means the joining and leaving. So that's again a signal, negative signal. Why the employee turnover is high? Why people are leaving the organization in quick sessions? Okay, now you have seen in certain banks, the CFO has been changed. Maybe 5 CEOs have in place for last 5 years. So it signals something wrong. So let's say the CEO coming, wait for 9 months, leaves. Another one come, wait for 12 months, leave. Maybe CEO, CFO, or maybe at whatever important level. Organizational changes. If the institution is subject to certain organizational changes in quick sessions more frequently, that again internal risk factor. Quality of personnel, again very important. Okay. Nature of fact. So there may be a lot of internal risk factors you can identify. The external risk factors, fluctuating economic conditions, changes in the industry and technological advances. Okay. What are the external factors that could affect your environment? Economic conditions, industry changes, technological advances, whether you are, you have advanced enough to meet those changes. Identification of operational risk event, internal and external frauds, place safety, clients, damage to physical asset system failures. So you have to identify both internal and external risk event, operational risk event, such as fraud, safety, clients, damage to physical asset system failure. So you must have a clear framework, but only thing is not like credit or market risk. Most of these things, if you look at operational risk events are very much limited in a bank. the data is also limited with respect to operational risk. So basically, when you assess operational risk, you have to go by most qualitative factors, qualitative events. Okay, so that is the difficult part when it comes to operational risk management compared to like credit and market or liquidity risk. Okay, then carry out business impact analysis and the business continuity and disaster recovery plan. Again, when you talk about operational risk management, two important thing is your business continuity and disaster recovery plan. Whether you have a BCP in place, this is very important. I think all of your bank has BCP in place. And also, if there's a significant disaster, how fast you can recover. Disaster recovery, DRP, we say DRP. So it's very important to do a business impact analysis. So what do you mean by business impact analysis? Now, sometimes the problem is how many of your banks have done any live testing on these things? Anyone has done a live testing?
So we are doing the live testing in terms of system failure, and we work with the disaster recovery center, which is located in somewhere outside. So it's quite.
How frequently you do? How frequently your bank do?
Yeah, typically we make it once in a not quarterly, really. Once in semi-annual, like we are presently doing that.
Okay, so that is very important. Now, sometimes the problem is, sometimes all of your bank may have a BCP in place, DRP in place, but you have not really seen it. You have not really practiced this until something happens. You don't know. There may be problems within your BCP, but practicing it semi-annually, at least semi-annually, is a good thing. Where you assume a certain bad event has happened, and you work from, let's say, your DRP side under the BCP. So you exactly come to know these are my problems when you start doing that. So you test your BCP. Then only you will come to know problem. These are my problems. So then you can address those things. So if you don't have practiced this, you have done impact analysis, then what happens? Suddenly, if a disaster takes place, or you have a system, but it will not work, then you are again in trouble. So it's very important, firstly, to have a BCP and DRP in place. Then secondly, to practice it, or at least annually. I think it's good if you can do it biannually. So that's again an important part of operational risk management. Then undertake compliance reviews by the internal audit and risk management department separately. So I said, if you look at the overall risk management, there are 3 lines of defense. One is what is the first line of defense? Individual business units. The second line of defense, the risk management department or the committee. The third line of defense is the internal audit. So let's do a review by the both internal audit and risk management departments separately on the different risk aspects. So that has to be in place under the risk management framework. Insurance covers to externalize risk. Remember, we looked at 4 ways of managing risk: risk acceptance, risk avoidance, risk mitigation, and risk transfer. So risk transfer means some of your pure risk events, why should you spend so much resources? So you can pass it into the external risk taker, like insurance company. So for example, risk of fire, risk of your vehicles being subject to accident, risk of cash theft. So you simply take an insurance cover. So basically you pass into the, so you have to identify what are the things you can externalize under an insurance cover. Then again, important thing is, now I think today's world, most of your banks are having some outsourcing arrangements. So again, there's a significant risk, operational risk associated with outsourcing when you outsource your certain functions. Okay. So have a policy framework in place. on outsourcing. These are my outsourcing arrangements. These are my risk mitigation. Now, for example, especially for a bank, one of the key problems in outsourcing is the information, because you may share some information about your customers or about your portfolios with outsourcing company. So the information security is very important. Data security is very important. So have a policy in framework in place. What you should out now, for example, in terms of, I think regulators guidelines, you can't outsource each and everything as well. There may be certain functions you can't outsource. So it's very important to have a policy framework on outsourcing. Then liquidity risk management. So what is liquidity risk? Anyone? Okay, liquidity risk is inability for a bank to meet its immediate obligations, we call the liability side liquidity risk, or meet its commitments, that is asset side liquidity risk. Very important. So this is one of the most important risks when it comes to a crisis, because what you call institution bank can survive at least for some time without capital. That is called insolvency. So insolvency risk. As far as the bank has liquidity, but if you don't have liquidity, even if you have capital, you will collapse immediately. So managing liquidity is very important for a bank. It's a quick death. Now, if you take patient with having a cancer and patient with a heart attack, so which one is more riskier? Patient with a heart attack, because it's like liquidity. But a cancer patient may die at the end, but it may not be instant. I mean, you detect the cancer today and he may not die tomorrow. Chances are sometimes they live for quite a long period until the death. But heart attack is much more riskier. Most of the patients die within a matter of time, very short period of time. So liquid risk is very instantaneous. If you don't take actions, if you don't have proper risk management in place, definitely. So remember I mentioned about the bank in Hong Kong. Nothing wrong. There was no risk, but the panic situation led to a significant liquidity crisis. So you must have board-approved liquidity strategy and policies. Again, asset and liability committee function. Then risk management. Liquidity risk management is a difficult task and can be measured through stock or flow approach. So when you talk about liquidity risk management, we have two different approaches. One is called the stock approach. The other one is flow approach. Now, stock approach is as a part of risk management, liquidity risk management, we identify liquid assets and demand liabilities. So it's a base of stocks we have, liquid assets. So in order to mitigate liquid risk, the bank may have sufficient liquid assets in place. Flow approach is, it's based on the cash flows. So how much cash is realized from your assets, and how much cash outflow going to meet the liabilities and demand for credit. So it's called the flow approach. So cash inflows and cash outflows, where the bank can estimate the level of liquidity bank needs. Okay, so you must decide the approach which you are going to adopt. Stock approach, the measure the stock of liquid assets in the balance sheet in terms of key indicators like net loans to total asset, loan to deposits, liquid asset to short-term liabilities, statutory liquid asset ratio, commitment to loan. So when you see these indicators are deteriorating compared to the benchmarks, immediately you must take appropriate measures. So these are the indicators you put in place under the stock approach to ensure you have sufficient liquidity. So for example, now SLAR is a regulatory defined key indicator where bank should have minimum 20% of its liabilities other than certain liabilities in the form of liquid asset. So if you see the bank's SLR coming below 20%, then immediately that's a signal of a possible liquidity risk event. Okay. Flow approach, as I mentioned, measures the required liquid assets to cover the net cash outflow. So we call the liquidity coverage ratio or the maturity gap. So bank can monitor the maturity gaps daily or weekly basis to see whether there are undue pressures on your net cash outflow, so that you can take actions on time. The bank should evaluate the liquidity profile under different stress situations. Remember, so we can measure, we can do some stress testing. For example, normal situation, how your liquidity profile moves up and down, how it works. Bank specific crisis. If there is a crisis in the bank, specifically to the bank, how your liquidity moves up and down. Then if there's a market crisis, like a systemic crisis, then how it would impact your liquidity position. So it's basically sort of a stress testing under different scenarios. So that is something you should do maybe periodically to assess your liquidity, ability to manage the liquidity and whether you are in a safe mode. And also liquidity contingency plan is very important, like BCP in operational risk, the contingency plan, whether you have a contingency plan in place to meet any liquidity needs in a emergency. Now basically what banks do is you have a what you call lending limits with your interbanks, or maybe contingency plan in a need, you have a credit line with another bank to support your liquidity. Now again, liquidity from central bank as the lender of last resort should not be reckoned for contingency plan. But now usually the last resort a bank has in a case of liquidity crisis is the lender of last resort facility, where the bank can go to the central bank and obtain a loan for a period, keeping certain securities. But for your liquidity purpose contingency plan, you should not consider. That is only the last resort, but you must have other sources, liquidity sources in place with other parties like your peer banks or any other agencies to support your liquidity. So those things should be in place in your risk management framework, so that anybody would know when it comes to a crisis what I have to do. Okay, I have a plan with bank B, I can borrow from them at this rate under that circumstances. So availability of backup liquidity support form of committed credit lines. So there is a liquidity backup, some credit lines with bank, reciprocal agreements, swaps arrangements, liquidity support from other external sources. So there may be a lot of other sources where backup facilities could be obtained in a crisis. So all this has to be kept in place, kept in your documents stating these are the possible arrangements, so that you can what you call initiate whatever the arrangement when it comes to the liquidity risk event. Interest rate risk management, again, it's very important risk as bankers, because most of your assets and liabilities are structured based on interest rate. If you take a loan, the fundamental variable is interest rate. If you take a deposit borrowing, fundamental variable is interest rate. So what is interest rate risk? The risk of affecting your assets and liability value or income due to changes in or the fluctuations in the interest rate. So interest rate goes up and down, will have either positive or negative effect on your balance sheet value and also your net interest income of your bank. So it's very important for the risk manager to ensure proper interest rate risk management policy framework in place. So like in other risks, you should have interest rate risk policies and procedures, policy in place approved by the board. Then again, classification of securities in trading, AFS and HTM. Now, what are the securities you book in your portfolio for the trading purpose, available for sale purpose, and held to maturity? Because the interest rate risk arises only for the trading portfolio, not for the held to maturity portfolio, or if it is transferred from AFS to trading. So it's very important because when it comes to trading, you have to market your portfolio based on the fluctuation and the interest rate risk in compliance with the accounting standards. So it's very important, this classification. Okay, then only you can assess the actual impact on your portfolio. Risk management, again, prudential limits very important. Value at risk limit, stop loss limit. Let's say when you see your value is coming down, so there may be a limit, stopping that. So immediately once the your loss comes to a particular limit, you exit the market. You exit from the market, which is called the stop loss limit. So the idea is, okay, you should not continue this loss, so once you, let's say, for example, let's say your bond portfolio value is, let's say, X amount, and you have a stop loss limit. If the value comes down below 2%, immediately exit the market. So that is called the stop loss limit. Okay. Maximum maturity. So what are the maximum maturities of investments you are going to make? Holding period. What is your holding period? So you beyond which you have to take an appropriate decision. You should not hold any portfolio of interest rate related instruments beyond that. So you say you specify this is my holding. Duration. Again, we will discuss about duration in detail, concept of duration. The maturity and duration are two concepts. When you talk about interest rate risk, basically we measure interest rate risk through the duration mechanism. This is average time to maturity. In other words, very simple terms, average time to maturity. So duration is longer means the risk is longer, sensitivity is longer. Position limit, like the foreign exchange, again, what is your position, interest rate risk related instrument position limit, rate sensitive gap limits. Again, what is the gap, maturity gap? Not for the liquidity risk, but for the gap. We learn all those things in detail when it comes to market risk management. So I'm not going to discuss in detail of those technical stuff, which will take time. Then again, impact on net interest income or net interest margin of banks due to movements of interest rate. So when you talk about rate sensitive gap limits, this is directly related to the rate sensitive gap limits. So whatever the interest rate changes in the market, how it's going to affect your net interest income or net interest margin. Okay. So you can monitor this continuously within your risk management framework. Any questions so far? Okay. So let's move to the stress testing again, which again I already explained. So what is stress testing? So under IRM framework, board is required to put in place a stress testing framework with approved stress testing policy and procedures. So it's very important to look at the possible adverse event which could happen in the future through a stress testing framework and identify potential threats, potential risks, and getting ready today to face that risk if it is going to happen. Because as you go on, if the event takes place suddenly, you can't do anything. So stress testing helps you to identify critical events that could lead to possible high risk for your survival and take action to it. Board to review the results of stress test regularly, including major assumptions. So especially you must review the stress testing results regularly, board, and see whether the bank has adequate resources to mitigate those risks. So stress testing policy should include identified principal risk factors which affect the bank's portfolio and required to be stressed. So you must identify what are the principal risk factors that could affect your portfolio, whether it's lending, whether it's market equity, or any other instrument. What are the factors that could affect, and what is the impact. So you stress those factors. For example, rising interest rates. If the interest rate goes up to this level, what is going to happen? If the NPL is going to this level, what is going to happen? If the US dollar appreciates to this level, what's going to happen? If the US dollar depreciates to this level, what's going to happen? So those are the possible risk factors you have to identify within each risk category. Okay, there could be number. I just gave a few examples. Number of risk factors. Then periodically you have to stress those factors and see the impact. Procedure for setting the stress tolerance limit. So basically, then you must have some tolerance limit. These are the limits within which I tolerate. Okay, so there should be a procedure for setting the limits. Necessary remedial trigger actions. Okay, so what are the remedies or what triggers a remedial action? It's very important. For example, let's say if the NPL goes beyond 8%, immediately trigger it. Inform the board, inform the management, take actions as defined. Okay. If interest rate goes beyond this level, immediately trigger, take action. It's very important. Delegation of authority to execute remedial trigger action. So the board should delegate authority for certain levels, CEO and other important people in hierarchy, KMPs, maybe credit chief credit officer, maybe the market head of market risk or whatever, head of operational risk, to execute remedial action. So whenever they see these triggers take place, they have the authority to take action. Okay, so otherwise there is significant risk when decisions are not taken on time because the authority is given. So you must specify in the policy framework those things. Frequency of stress testing depends on the activities and the risk level, daily, weekly, monthly, quarterly. So it varies from one bank to another bank. Scope of stress test. Scope means the level, okay, whether minor, moderate, and severe. So you can do a stress testing for minor events. Let's say NPL increased by 10%, moderate NPL increased by 25%, high NPL increased by 50%. So likewise, different scenarios, you can do the stress testing. For minor event take place, what is going to happen to your net income? What is going to happen to your asset value? What is going to happen to your liabilities? What is going to happen to your loans and so on? So it's a minor, so moderate, then severe. So you must define in your scope the level of stress testing. You may not need to have all, sometime a particular bank decide I'm not worried about minor stress testing, I will only do for severe stress testing. So this is my scope. So that again depends varies from bank to bank. Again, important the disclosure requirements as a risk management, as a part of integrated risk management framework. So again, the principles are board-approved disclosure policy of internal controls on disclosure process, the balance between quantitative and qualitative disclosures. So what are going to disclose in terms of numbers, quantitative, and key points, the qualitative aspects, okay. Disclosure requirements, you can disclose about strategies and policies. These are the strategies and policies you adopt with respect to risk management, structure of the risk management function, especially if you see an annual report of a bank which is published, there are several disclosures published in the annual report. So what was the strategy adopted by the bank, structure of the risk management function, scope and nature of risk reporting and MIS, policies for hedging or mitigating risk, strategies and process for monitoring of risk. So it clearly specifies within your IRMF, these are the disclosures I am supposed to do. Certain disclosures may be for the internal purpose, certain disclosures may be for the external purpose. For the other stakeholders to take appropriate decisions. So both internal disclosures as well as external disclosures are very important for, as a part of governance framework as well. where the people know exactly, what are the things you have to report internally as well as externally with respect to the risk management function. So no one can, no one can be confused, because exactly these are the things we have to disclose with respect to risk management framework. So that is again a part of your IRM framework. So basically, those are the key aspects of IRM framework, starting from the board responsibility, the oversight, then what is expected from the senior management, the auditors. Then we discuss different aspects with respect to different key risk elements: interest rate risk, credit risk, liquidity risk, market risk, and so on, operation risk, and so on. Then we looked at stress testing, what are the policies and what you should do with respect to stress testing within the policy framework. And finally, the disclosure requirements with respect to the overall risk management framework. So broadly, that covers the introduction to the risk management. And probably you will go into details of risk management with respect to different risks, starting from credit risk from next module onwards. So probably next week, next resource person will take over with credit risk module and continue for a few weeks. And then you will have the other modules in the syllabus. So that's basically for the introduction. Any other questions before we wind up for the day?
Hello, sir.
Yes.
So CBSL is the lender of last resort for commercial banks.
Yeah.
Is there any particular instrument that commercial banks use to raise funds or finance from CBSL?
No, they usually in day-to-day liquidity, they go through the open market operations. Okay. So daily they go to the repo and reverse repo window, and they can borrow or they can park their excess liquidity in the central bank. But lender of last resort is when all the other avenues are failed. There is no other avenue where banks can go to the bank as a last option, central bank as a last option. That means bank it has a highly risk position, so almost near collapse, and get a facility from the central bank, and it is called the bank rate. Now, bank rate is a little bit a higher interest rate. Of course, some time back it was very high, but now, of course, come to a level of around 8% with recent declining interest rate, where basically the central bank discouraged banks to ask for a bank rate loan. That is the last, like a patient is in the ICU, where you need some, what you call breathing gadget. Last resort, you can't breathe anymore, so they fix, ventilators and all those gadgets. So it's a last resort, but of course you have to keep some securities again for that, and there's a penal rate applied. Penal means a higher rate than an open market window.
Okay. So the repo and the reverse repo is the SDF and the SLF, right?
Yeah. Now earlier we used to call reverse repo and reverse repo. That is what you call standing deposit SDFR. SDFR is basically the deposit facility rate where you can park to excess liquidity, and SLFR is basically the lending rate by the central bank. If you need some money for short-term purpose, you can keep your securities as collateral and obtain a facility overnight or for medium term. So that is called SDFR and SLFR. Earlier we used to call repo and reverse repo.
Okay, so thank you.
Okay, any more? Okay, so if you don't have any more questions, I'll stop for the day. It's almost 12:35 here in my this laptop here. So I think hopefully you can revise what we discussed during today and last week. And if you have any questions, probably you can discuss with me when I start my modules again, maybe some weeks later. So next week it is Mr. Lalit Fernandu who will take over. Okay, who will take over the next module, and he will continue with the operational risk module as well. I don't know whether it's continuously. So I will take up again with you with respect to market risk module and liquidity risk, and then the Basel capital framework, and I think that's what I have to cover. So if you have any questions, I can discuss those when I start my module. But of course, you can discuss anything with the next resource person as well, with respect to any general risk management issue. So see you maybe a few weeks later. Thank you.